I think generally people are pretty optimistic.
You need to own the winners. Everything we're doing, I think the rest of the world should be copying.
When we look at the rest of the stocks in the S&P 500, there are some cracks.
In the near term, caution is warranted.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, hello November. Big tech putting the S&P 500 on a 6-month winning streak as the White House is bracing for a Supreme Court hearing. Investors are gearing up for another week full of Fed speak. Governor Miran joins the program in the next hour.
It'll be really interesting to see how he justifies dissenting by 50 basis points and not, as we heard from Bob Michael of JPMorgan, by 75 basis points or 100 basis points next month or in December. Will he have a bigger dissent? And does the lack of official data concern him, or does he feel like there is plenty to go on in order to have bigger cuts?
Typically, we'd be looking forward to a payrolls report. First week of a new trading month. No payrolls report coming up on Friday. We're in the dark still, and this government shutdown is on course for the longest on record. And arguably this week, the White House won't be focused on Congress. The White House will be focused on the Supreme Court.
And the president told 60 Minutes yesterday what's going on at the Supreme Court with IEPA having this decision, or at least the start of it, with the oral arguments kicking off this week. He thinks it's the most important subject discussed by the Supreme Court in 100 years. And it's very consequential this week. The Supreme Court is going to uphold that the president is allowed to use IEPA, this very blunt instrument, or the Supreme Court is going to strike it down, and then potentially as much as $90 billion is going to have to be refunded to businesses. Can cause a lot of chaos.
A core point of difference, I think, for Governor Miran right now and the rest of the committee probably comes down to tariffs. For him, it doesn't matter if they're on or off. It doesn't really make a difference for the disinflationary story that he's forecasting into next year.
And you know what? There are a lot of people who agree with him. And frankly, the early data suggests that that is true. And actually, you have not seen that big of a hit from the tariffs. You have seen some people speculate you will see the price increases early next year. Nonetheless, the bigger question is inflation is above that 2% target. It has been for 5 years. At what point does that in and of itself concern him? Is he tacitly accepting a 2+ inflation rate, or is he saying it'll get down there because of housing, which has been his biggest argument?
And Lisa, financial conditions are super easy. The credit market is wide open. Alphabet, the latest to tap the European debt market. Last week, Meta selling $30 billion worth of bonds. And this is the pushback coming from the Kansas City Fed president. This is why he dissented the other way. This market is not tight.
Frankly, financial conditions never seem to matter unless stocks are going down. Well, for Jeff Schmidt of the Kansas City Fed, it was the opposite. He actually was concerned about this with the tech giants. This follows the $30 billion deal, as you were talking about last year, coming out of Meta. And then, of course, we had the Oracle deal, which was also massive. It raises a question. Is the Fed fueling a speculative bubble if they are keeping rates or lowering rates where they are based on the capital market activity that we've seen so far?
Very close to all-time highs coming into November, closing out October on a 6-month winning run on the S&P 500. Futures this morning up by a third of 1%. Coming up this hour, we'll catch up with Jim Bianco of Bianco Research with stocks on a 6-month winning run. Tobin Marcus of Wolfe Research with U.S. tariffs heading for a Supreme Court hearing. And Andrew Hollenhorst of Citi looking for Chair Powell to keep cutting. We begin this hour with stocks rising, fueled by big tech and easing trade tensions. Jim Bianco of Bianco Research writing the real AI bubble is pessimism about not owning enough of it. AI stocks are already at a record concentration for one theme, 48% of the S&P 500. Jim joins us now for more. Jim, welcome to the program, buddy. Are you suggesting we haven't seen capitulation yet?
No, I don't think we have, but we're getting very close to it. It might have actually process might have begun last week with the earnings reports that we saw from these companies. Now that I've said that, that capitulation process could take several months, or it could take a couple of weeks. But there seems to be a movement towards everybody's got to get into AI and just full speed ahead right now.
What does the rest of the market, Jim, say about the broader U.S. economy? This came from Jonathan Krinsky of BTIG, that a record high we hit on Wednesday just last week. 33% of the components of the S&P down 20% or more from a 52-week high. What tells you more about the broader economy?
I think the rest of the market does. And you're right. If you were to exclude the AI stocks, and we do an exercise of it like a lot of other people do, you've got maybe the rest of the non-AI stock market up 6, 7, or 8% for the year. And to put that into perspective, the bond market, the Bloomberg Aggregate Index, is up 7% for the year. So the rest of the market is just performing in line with the bond market right now. And it's showing you that the economy is, okay. 7% return after 11 months is not necessarily a...
Jim Bianco of Bianco Research. It looks like we've got a technical issue with that connection. When we re-establish that, we'll come back to Jim in a couple of minutes' time. We call it earnings season, Lisa. I call it cherry-picking season. Pick a story, tell a story, pick a name, whatever you want. I'm going to pick Chipotle last week. That tells you a lot, I think, about why the people who aren't concerned about inflation are more worried about the labour market. Chipotle basically telling you the consumer slowdown has affected the business and we don't plan to offset higher costs with higher prices. That's Chipotle. They've got their own problems, I know. But if you were to cherry pick one story to support the Governor Miran argument right now for lower interest rates, that would probably be it.
Yeah, Chipotle, is it the Chipotle economy or is it the Delta economy? I would give you another one, eBay. Lori Calvasina came out with a quote that was from their earnings call saying that there were greater orders of used parts for people who can't afford to replace an actual item that is a big ticket item. There is a sense around the margins, there is a real deterioration around consumer discretionary and consumer staples, apart from the high-end luxury, that has caused a lot of concern. And it's the reason why Torsten Slok last week said there is a K-shaped market. It is not just an economy where you see the Mag 7 gaining in profits and you see the rest of them not so much.
Jim Bianco, we've re-established that connection. Jim, welcome back into the show. Let's just build on what Lisa and I were talking about. The Chipotle economy, the Delta Airlines economy. Which economy should this Federal Reserve be setting interest rates for? The Chipotles of this world or Delta Airlines? Because one means rate cuts and the other means something completely different.
It does. And I think the Fed has to be careful here because they operate under the financial channel. And the short answer you'll hear is stocks are at an all-time high, housing's at an all-time high, M2's at an all-time high, gold's at an all-time high, crypto's near an all-time high. What problem are you trying to fix with the financial channel? So if they want to cut rates, they're just helping the top 10% or the top end of the K by pushing markets up. It's not necessarily going to help the bottom of the K. The bottom of the K needs more in terms of production increases and maybe changes in demand in order to help fix that. So necessarily cutting interest rates to help push the stock market to new highs and push maybe M2 up higher and to push housing prices higher is not going to definitely help the broad masses of the economy.
That said, Jim, one argument against that is that actually cutting rates will help people with auto loans or student loans or some of these short-term lending instruments that have been the most onerous for the lower end of the K-shape. I mean, do you just reject that? You say that the bang isn't worth the buck just based on the fact that it will inflate something of a bubble?
If it works, because if you go back to last year's rate cuts in September of 24, after the Fed started cutting rates, long-term interest rates went up, and there was no relief in any of those other loans because they're set at market rates. And the reason was the market looked at those rate cuts, was worried that it was going to be inflationary, and interest rates rose. If the market was to see a series of aggressive rate cuts right now as potentially inflationary, you could see a repeat of that where long-term interest rates will go up. It's not a given if the Fed cuts rates that long-term interest rates will follow lower. Last year is a great example of that.
Jim, does it concern you that a lot of the big tech names are issuing more debt, that there is leverage starting to creep into this tech-driven cycle in a way that really hadn't been the case a couple of years ago?
Yeah, it does, because they're starting to, imply that the build-outs that they want to do and the impact on the economy is not going to be funded out of cash flow like they were telling us literally earlier this year, but that they're going to start borrowing. And that's going to put more pressure on them to see a lot of this AI and a lot of these build-outs produce profits and produce cash flow. Right now, if they were funding it out of their own profit operations and not borrowing, they'd have a little bit more runway in waiting until things were profitable. So it's going to compress this cycle that they're going to have to start making money much sooner than they maybe thought a few months ago.
So there are two sides of this. On one hand, you could say this actually injects more discipline on these companies. And we've seen that with Meta over the past week after their earnings report and people were concerned about their spending. You could flip this on its head and say, well, if the Fed cuts rates, it will only fuel the bubble that much more and make people sort of more accepting of any kind of leverage. Which do you see as the more likely scenario?
I'm more in the latter camp. I know Chairman Powell said at his press conference on Wednesday last week that all of this AI funding was not interest rate sensitive. Yeah, that's true. No one at Meta is sitting around worrying about what the interest rate they're going to get on their 30 billion bonds are. But the banks and the hedge funds and everybody else that's getting cheap money is desperate for something with yield, and they're willing to buy something like this. So the Fed rate cuts do, at least on a secondary measure, help push these things higher. And I think that this is going to be really important as we move forward, is that this easing of financial conditions is going to have a second order effect in the economy, especially the AI economy.
Jim, John mentioned at the top of the show that it's day 34 of the government shutdown. How important do you think is it for the government to open and to get the data back out and flowing for this Federal Reserve to cut in December?
I mean, it's actually more important for the Federal Reserve than it is for like the rest of Wall Street, only because there's plenty of private data out there to give us an idea of where the economy is going. Earnings last week, we had almost half the S&P report. We've got, something like 50 or 60 S&P companies reporting this week. So we've got a pretty good idea where the economy is. The problem is the Fed works on models based on government data, and they're not getting that data. So it's more of an issue for them than it is an issue for, say, investors saying, do we really have a good handle of where the economy is?
Jim, are you basically saying that you don't need BLS data anymore? What if we never get it again? Would this market be fine?
I mean, you could adjust for it. You've already seen ADP come out with a new pulse report that's putting out weekly numbers. There are ways that the market will adjust and fill that gap if we never were to get BLS data before. Now that I've said that, we are going to get BLS data before again, because this government shutdown will end. I know it seems like it's going to go forever, but it will end at some point. Now, we may not get October data. There might be a permanent hole in the data series, but we will start getting data again.
Well, Jim, I think Annmarie gets to something important, though. I think the key issue right now for a lot of people is this equity market is completely decoupled from payrolls growth anyway. So even if it comes back, how instructive would it actually be for the direction of equity markets?
Well, I think it would be instructive for the rest of the non-AI equity markets, because they still operate on cash flow profits, outlook, and strategy, and all of those other things, and that the state of the economy will matter a lot more for them. But the AI economy is operating on something completely different. I'll give you one quick example. Look at the Mag 7. Which is the worst performer in the Mag 7? It's Apple. And what does Apple not have? An AI strategy. It seems like the market is punishing anybody who decides not to play in AI like Apple and wants everybody to play in this game. And it's so everybody's got a chance, has to play. So the AI stocks are going to keep playing until at one point there's the demand for profits. But the rest of the economy is definitely going to need to see some data, and it's going to need to see some clues as to where the economy's going.
Hey, Jim, appreciate it. As always, Jim Bianco there of Bianco Research on the latest moves. Just to sit on tech, Lisa, these tech companies are changing. They're very different. We used to reward them for being asset light and capital return heavy. And now that story might be making a turn.
Yeah, we're rewarding them for saying AI 15 times on their earnings call and talking about cloud growth and domination there. There is a question here, especially as you see each of these tech giants seek control over the energy infrastructure and some of the cloud computing abilities, just how much they are leveraging themselves to a model that will dramatically change a la DeepSeek in China.
The Nasdaq 100 this morning higher by 0.6%. If you're just tuning in, welcome to the program. Let's get you an update on stories worldwide this morning. Here is your Bloomberg brief. The United States pausing some of President Trump's reciprocal tariffs on China and halting plans to implement a 100% tariff on Chinese exports to the US. In return, China immediately suspending export controls on rare earth metals and dropping its probes into US chip firms. Elsewhere, the US government shutdown is in its 34th day and on track to be the longest ever this week. President Donald Trump telling 60 Minutes he, quote, won't be extorted by Democrats demanding an extension of Affordable Care Act subsidies that expire at the end of the year. And finally, Microsoft signing an approximately $9.7 billion deal to purchase AI cloud capacity from Miran, becoming the Australian company's largest customer. The 5-year agreement will provide Microsoft access to NVIDIA accelerator systems in Texas. Microsoft this morning up by 0.3%. Up next on the program, the Supreme Court taking on tariffs.
I think it's one of the biggest decisions in the history of the Supreme Court. I wanted to go so badly. I just don't want to do anything to deflect the importance of that decision. If we don't have tariffs, we don't have national security.
That conversation up next with Tobin Marcus of Wolfe Research, live from New York City this morning. Good morning. The week ahead has something big missing for Friday. No payrolls report. Plenty of data between now and the next one. We get ISM manufacturing later on this morning at 10 a.m. Eastern Time. ISM services coming later in the week in 2 days' time, so look out for that. And the ADP data just takes on additional importance all over again, Bramo. We're still getting economic data. We're not exactly flying blind.
I remember when people didn't care about ADP and they said that it never cohered to the non-farm payrolls report. So ignore it. They still traded on it. But nonetheless, this time around, just think about how trigger happy everybody's going to be in any kind of capacity, especially given the fact that they're increasing their surveillance and some sort of approximation of the weekly payrolls as well.
Jim Bianco made a really good point. The Fed needs the official data because that's what all their models are tethered to. But the market could just look elsewhere, which is why I think December becomes really challenging for them. Do they look even political if the government's still shut down and they're not getting any data? And I think it's why Jay Powell spent a lot of time talking about the shutdown at that press conference.
Inflation around 3%, GDP around 3%, unemployment around 4%, equities at all-time highs. When we catch up with Governor Miran in the next hour, that's kind of the pushback from the other side of the committee right now. Do we really need these interest rate reductions?
Where's the pain? Where is the financial sector that would actually be the transmission mechanism that will cause some sort of benefit to the economy that isn't already there because credit markets are wide open? That is the pushback. That is what we heard from Schmidt. And here's the question for me. At what point does he reject that, despite the fact that we have no data?
Governor Miran, 7:15 Eastern Time, right here in the studio in New York City. Equity futures on the S&P with a lift once again up by 0.4% on the S&P 500. On the Nasdaq 100, higher by 0.6. Under surveillance this morning, the Supreme Court taking on tariffs.
I think it's one of the biggest decisions in the history of the Supreme Court. Other countries use tariffs against us. I wanted to go so badly. I just don't want to do anything to deflect the importance of that decision. If we don't have tariffs, we don't have national security. And the rest of the world would laugh at us because they've used tariffs against us for years.
So here's the latest this morning. The Supreme Court set to hear the biggest challenge to date to President Trump's tariff policy on Wednesday, with the ruling poised to determine the outlook for global trade. Tobin Marcus of Wolfe Research joins us now for more. Tobin, welcome to the program. Your expectations for later this week and beyond. What do you think the final decision will be?
Yeah, so I'm a little bit out of consensus on this in believing that the tariffs probably will survive. It certainly could go either way. I'd put the odds that they're struck down around 40%. I think consensus is more in the 65% range. The arguments against the tariffs, I think, are fairly clear. Obviously, we've seen both the circuit and district courts rule against them. But at the Supreme Court level, I think there's a few considerations. One, the center-right bloc that's going to be decisive on the Supreme Court does tend to be very deferential on questions of national security and foreign policy. I think that Chief Justice Roberts also is very protective of the court as an institution from a political perspective. So he's going to be a little bit wary of upsetting the apple cart here, especially as more and more trade deals have come to depend on these tariffs. And then finally, if you just look at the Court of Appeals for the Federal Circuit, the most recent, the highest level ruling that we've gotten, the majority of the Republican appointed judges on that panel dissented from the decision, striking them down, and said they would have upheld them, as did two of the Democrats. So it's not that it's been uniform against them so far, but the composition of the courts that have ruled against the tariff so far is very, very, very different than the conservative-dominated Supreme Court.
Tobin, some may agree with you in terms of the fentanyl tariffs, that is a national security concern. But what about reciprocal tariffs? Do you still think that would be considered a national security concern at the Supreme Court?
Yeah, so I think they will rise and fall together because I really do not think that the grounds on which the Roberts Court is going to want to decide this is factual second guessing of what is and is not an emergency. I think that's the last thing that they want to do. I think it's going to be decided as a question of law, not as a question of fact. So I don't think they're going to be looking at these two separate IEPA emergency declarations and saying fentanyl's legit, the persistent elevated trade deficit is not. I think they're going to be looking at, does IEPA give you the power to do tariffs at all? And if so, I think both of the national security declarations are sort of facially credible. This came up a lot at the circuit court level. The states that were challenging the tariffs were sort of poo-pooing the legitimacy of that emergency declaration. And some of the judges, even judges sympathetic to their case on the panel, were like, well, look here in the presidential declaration, it talks about undermining our manufacturing base. It talks about military readiness, these various different things that Trump says are imperiled by trade deficits. You can question that argument, but there is an argument that's being made.
Last week, a handful of Republicans decided to approve a resolution that would end the national emergency powers the president has when it comes to trade. What kind of pushback do you think you could see from some members of the Republican Party in Congress if the Supreme Court upholds IEPA?
I think they will continue wringing their hands as they have. That's generally as far as they're willing and able to go. I mean, that vote that we saw in the Senate recently was basically symbolic. You would need the House to do it to actually have that have any legal force, and then the president can veto it. And there's not the level of dissension on the Republican side to overcome a veto. So, there's plenty of more traditional free market types in the congressional Republican coalition. They will continue saying that they're concerned about how these tariffs look, but ultimately, if the Supreme Court gives the president the latitude to go forward, then these tariffs are going to stick.
Tobin, there are a number of elections tomorrow around the country, in particular New Jersey, Virginia, New York. And I'm just wondering, if there are Democratic wins, do you think that will affect the way that the president responds to any potential court decision that could come on Wednesday, or not on Wednesday, but after the Wednesday arguments?
Yeah, I'll throw California into that bucket also, where we're watching the ballot initiative to allow them to move forward with redistricting. I don't really think, look, from our perspective, as we're sizing up the midterms, looking at the extent to which Democrats not win, but sort of overperform or underperform their expected margins in those races is going to shape our view of the cycle. Certainly, the Democrats are expected to win both those gubernatorial races. If there's an outright loss, that would be a huge victory for Republicans. But I think it's really a question of where the margins come in. But I think you need to see a very shocking result for Trump to change his actual kind of policy strategy in response to those results. If Republicans do well, he's going to be triumphant. If they do poorly, I think he just won't say that much about what the outcome there.
Tobin, we are also looking at a government shutdown that's poised to be the longest ever come Wednesday. Do you think that could change some of the navigating of the president with respect to how to negotiate with the Democrats, depending on Tuesday's outcome?
Yeah, so, there's one theory the Democrats are going to sort of become more willing to end the shutdown once they get past these elections. They don't want to pack it in before the elections happen in Virginia because they want to be able to tell federal workers in particular, we're fighting for you, that kind of thing. I'm not really sure that it's going to be that big of a catalyst, but it is one of a number of things coming up, along with possible interruptions of SNAP benefits and air traffic controller stickouts and so forth that, could get people talking a little bit more than they have. Again, I think the president feels generally, and to some extent correctly, that Republicans are in just a position of strength across the board. And so even if you see Democrats doing fairly well in these pair of off-year elections, I don't think he's going to feel vulnerable or that he needs to sort of approach the Democrats in a less from a less dominant position. I think certainly as it comes to the shutdown, the view from Republican leadership is going to continue to be, we're going to talk policy if and only if you guys agree to end the shutdown first. That's always been the position of both parties, and it's sort of hard to move off that because you can't concede the principle that the minority can demand policy concessions based on shutdowns.
Tobin Marcus, appreciate it, sir. As always, Tobin Marcus there of Wolfe Research. In the short term, at least, I'm not sure this is on the president's radar as even a top 3 issue at the moment.
The shutdown? Not really. He thinks that the Republicans hold the cards here, and at some point, moderate Democrats are going to have to pick up those votes. He basically said that yesterday in 60 Minutes. And I still am watching Virginia and Maryland, maybe after we have this event in terms of the elections tomorrow. These Democrats might end up saying, OK, time to reopen the government because our federal workers are not getting paid.
The focus firmly elsewhere. Coming up on the programme, we'll catch up with James Foley of Rabobank with the dollar riding strong momentum. Plus, Danny Berger with your morning movers. Berkshire Hathaway rising on a massive profit rebound and record cash pile. From New York, this is Bloomberg. 3 straight weeks of gains on the S&P 500, the longest weekly run since the middle of September. Equity futures right now adding some weight to the rally, coming into November on a 6-month winning run, the longest going back to 2021. Equity futures on the Nasdaq up by 0.6%. On the Russell, a lift there as well, up by 0.1. In the bond market, bond yields down on the last month, but up in the last week. The 2-year yield just taking a temperature of a very divided committee at the moment. 2-year yields at 357.78. Chairman Powell pouring some cold water over a December rate cut, and a chorus of hawks coming out in support on Friday into the weekend.
Listing everything from inflation to financial conditions that seem fairly easy as a reason not to cut again in December. How much does this cohere with the strength that we've seen in the dollar, which also has upended a lot of the consensus trades that we've seen so far this year?
Bond yields just pushing higher just a little bit on the session once again. More on the US dollar in just a moment as we count you down to the opening bell. About 3 hours away, let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, John. Over the weekend, we had earnings from Berkshire Hathaway, shares up 2 1/3%. Operating profit jumped by 33%. And as tends to be the case for their earnings, the cash pile grew and continued to hit new records at $380 billion. It's now equivalent or more than a market cap of P&G or Home Depot. One of the big earnings we're also going to be getting after the bell today is Palantir. Shares are rallying ahead of that. Shares are up 160% so far year to date, nearing 170%, I should say. Expectations are for revenue to jump 50%. Options are pricing in a 10% swing for the share price, so expectations clearly high for the company when it reports. Finally, wrapping things up with another day of AI deal news. This time, it is Microsoft that will be buying from IREN $9.7 billion worth of cloud capacity. Will make it one of the Australian company's largest customers. As part of that, they get access to NVIDIA processors. They're also going to be buying some equipment from Dell. So Dell also moving on that news. But yet again, another AI deal. John?
Danny, thank you. There goes another one. Danny Berger there. More from Danny in the next hour. On our radar this morning, President Donald Trump skipping this week's Supreme Court hearing over the legality of his tariff agenda. Wednesday, justices will hear arguments looking to strike down most of the levies Trump has imposed since returning to office. Elsewhere, President Donald Trump declaring NVIDIA's Blackwell chip will not be available for other countries. Trump hinting a scaled-down version of the chip could be sold to China. And finally, Alphabet becoming the latest tech giant to tap into the debt market. People familiar with the matter telling Bloomberg that Google's parent company is looking to raise up to $3 billion in euro-denominated bonds to fund record AI spending. Speaking of, there goes another one. There goes some more debt to fund this big move.
Yeah, and you could say $3 billion or 3 billion euros is a rounding error compared to the $30 billion from Meta and the $28 billion from Oracle. Nonetheless, it builds on this trend that we've seen, and tech-related debt has actually superseded financial debt in the investment-grade corporate bond market for the first time in a very long time. It raises a question. Is this a new cycle of risk where it's being transferred from the equity holders to the bond holders at a time where there is a very different business model emerging?
Meta is talking about, at least on their conference call, that 2026 spending is going to be notably larger. And then the Microsoft CFO basically was saying, what bubble? We cannot do enough to meet demand right now. And they're talking about, I thought we were going to catch up. We are not. Demand is increasing that much quicker. So everyone that says we're in a bubble, then you go on these tech earning conference calls, you hear from the CFOs, and they're basically saying, actually, we feel like we're behind when it comes to this race.
Up until now, the market had been rewarding this behavior. I say up until now because Meta still had a massive order book on that debt last week. The market had been rewarding this kind of behavior. Coming into the debt market, fund those ambitions. We're wide open. You can do that. Take on some leverage. We've talked for years and years and years about strong balance sheets, cash-rich companies. Lisa, to your point, are we starting to see a change in behavior? And is the market going to continue to reward these companies for it? Or was last week the first real test, just the first little bit of pushback for Meta and maybe others to come?
Yeah, and where is the pushback going to come? Is it going to come from the bond market, or is it going to come from the stock market where people realize it's going to cost something to pay this back? And Jim Bianco is saying if the Fed cuts rates, he's worried that it could fuel some of the leverage and fuel some of the expectations of bubblicious types of behavior, because it will incentivize income buyers to keep on going those bonds and rewarding that behavior, even as stock traders are starting to get a little bit nervous.
Last week it came from the equity market, hasn't come from the credit market just yet. More on that with Amanda Lynam of BlackRock. She joins us in the next hour. Let's turn to the FX market and the US dollar. Bloomberg's dollar index on track to reach a 6-month high, continuing to rebound from a shaky first half of the year. Jane Foley of Rabobank writing, we have not been forecasting a continued slide in the dollar's value next year. Jane joins us now for more. Jane, welcome back. Only 6 months ago, we were talking about sell America. The dollar trade is over. A dollar bear market is upon us. And you and I talked about about this. So much of that was the first half, the first quarter of 25. What do you expect 26 will bring?
Well, that's a really good question, because I think many people are still surprised that if you look at the second half of the year to date, well, the dollar is the best performing G10 currency. So not only has it done well, in October, where it was the best performer, it's actually a lot longer than that. And that sort of goes against a lot of people's instincts. I still have people talking to me about, dollar weakness. And yes, those drops in the first 5 months really of this year were so extreme. But actually, the dollar has done a fairly good job of recovering its ground. And I think that really does question this consensus trade about, we're heading to 120 and beyond. I mean, the consensus is still of that view. And I think right now we need to stop and rethink. Now, it is difficult to rethink because obviously we don't have the US data. But I think that most of the weakness that we had in the first, say, 5 months of this year was really position adjustment. Since the global financial crisis, we've had this big increase in investment from non-dollar-based investors, a lot of it going into the S&P, into US assets. And at the start of the year, people were sort of questioning that. And I think they still are, to be fair, the diversification trade. But, does that mean that the dollar can carry on plummeting? Well, I don't think it does. And I think the dollar, will be a lot more stable. And I'm really beginning to question whether or not we're going to see, any significant dollar losses from this juncture in.
Well, Jane, let's address the rate picture as well. That's a key feature of the conversation into year-end. Chairman Powell backed away from signalling any kind of interest rate cuts into year-end. Bob Michele at JPMorgan, Lisa mentioned him earlier. He was on the programme with us on Fed Decision Day. He pushed back too. He said Chairman Powell has entered the lame duck part of his term. Now, Jane, what are the FX complications associated with Chairman Powell, lame duck, into year-end and going into May next year?
I think it's the May next year, which is potentially more risky for the dollar, because that is, I think a risk factor if the market does begin to question Fed independence. But even that, we can't even judge that is going to happen, because it really does depend on the economic data. So, for instance, right now the market is forecasting quite a progressive decline in Federal Reserve interest rates, because it expects the labour market in the US to loosen. Now, as long as there is a broad consensus amongst economists that the Fed is going to ease, well, if it does ease, well, fine. Nobody is going to be saying, Trump is trying to undermine Fed independence, because if the market continues to agree with him. But the difficulty is if the US data perhaps shows more resilience, and then we get a big push from the administration on the Fed to cut. That's potentially when we could get, a cracks emerging in the independence of the Fed. So that's a risk factor for the dollar. That would raise market expectations about inflation. It could undermine the dollar, for instance. But if the US economy remains broadly on track relative to market expectations now, well, that's going to be less of a factor too. And given that there is so much easing already priced in, actually, the dollar could demonstrate a little bit of strength, as it did at the end of the week, if the Fed doesn't cut quite as much as the market is expecting.
Jane, is it rate differentials that's actually determining the value of the dollar versus comparative currencies, or is it growth differentials, or is it simply a momentum trade?
Well, I think it depends which currency pair that you're talking about, because I think if we were talking about dollar yen, well, I think there's a momentum trade right there now, that the market does or has wanted to take the yen weaker. I think if we judge currency pairs generally, though, we can't get away from rate differentials. They are there. But I think once you get politics embedded in this, if you were to get issues such as central bank independence coming through, then you do get other issues coming through. And don't forget, the Bank of England may not be completely resilient to issues about independence going forward too. If there were a general election now, we'd probably get Farage, and Farage would certainly want to undermine the Bank of England independence. So this could be an issue for other central banks going forward too.
Jane, the reason why I ask is because it's notable that in the past 2 weeks we've seen dollar strength from the DXY and BBDXY indexes at the same time that we've seen gold weakness. And I wonder if there is a correlation here, if there is something going on, or if it's just simply, correlation was not causation.
I think it's difficult to see correlations in such a short time span. Often we have to step back and look at these over a much longer time frame. And I think what we had with gold was just, the market was just getting a little bit too heady. The retail investor was getting a little bit too heady. So almost certainly a little bit of dollar strength, it created a little bit of profit taking. But I do think the relationship between gold and the dollar is important, because I think what we have right now is still a diversification trade. And I think this is really valid. So I've never really bought into the dollar debasement trade. I really don't think that is an issue. But I do think it is valid to look at other aspects of the global economy. So, for instance, I mentioned that since the global financial crisis, a lot of money has been plowing into US stocks, into US bonds, for instance, into the dollar. And I think right now people are stepping back and thinking, well, what about Japanese stocks? Because there's been a lot of reform in the Japanese stock market. There's been, Japan is coming out of 30 years of deflation. You've got a lot of interest in stocks right now in parts of Africa, and that's because of minerals. So, of course, and earlier this year, there was a lot of interest in the Eurozone because of Germany's debt break issue. So I think the diversification, and gold is part of that because of the central banks like Russia and China buying gold. I think gold is part of that diversification trade. But I think what we saw in gold, in the last few weeks is just a little bit of profit taking because it just moved too fast, too soon.
But Jane, you think it's acting as a store of value rather than as a currency, is that correct?
I think the gold is certainly a store of value. I mean, we have that. I mean, that's historically over thousands of years. People be able to take it with them in terms of crisis. You can't do that with property. And that's why gold has its intrinsic value. With respect to the dollar, though, it also has a massive safe haven appeal, and that is just the sheer depth of the US capital markets. And also, if you look around the world, the dollar is used by so many people as a transaction currency. And if there were to be any sort of crisis, many people are going to think, I need to get my dollars to pay off my dollar-denominated debt or to pay my bills. So from that point of view, the dollar, in my view, will remain a safe haven value, for decades to come.
Jane, you mentioned Nigel Farage, and a few days ago, there was a poll where he was leading slightly over Keir Starmer. A Nigel Farage prime minister, is that pound positive or negative?
Well, that's certainly what the polls would say. If there was an election in the UK tomorrow, and there isn't going to be an election for maybe 3.5, 4 years, that sort of time frame. But certainly it would appear that Reform would certainly win the election, and that would put Farage as its leader, as the most likely candidate for Prime Minister. In terms of the pound, what he is saying sounds attractive in terms of the fiscal situation, in terms of saving money. But actually, if you look at his voter base, they are generally older people, and it would be very hard for Farage, therefore, to cut back on some of the benefits that older people get in terms of, pension gains, etc. And that means that possibly there'll be a lot of disappointment over the policies when it comes to welfare and pension reform if Farage were to take the reins.
Hey, Jane, always good to see you. Jane Foley there of Rabobank on the FX market. The dollar stronger against absolutely everything in G10 through the month of October. That's the FX price action. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. The President, Donald Trump, threatening possible military action against Islamist militants in Nigeria unless the country's government holds the killing of Christians. Trump designating Nigeria as a country of particular concern. Elsewhere, oil is holding steady after OPEC Plus announced plans to pause output increases at the start of next year. The group and its allies saying they'll raise production by about 137,000 barrels a day in December before taking a break from January to March. And finally, Ryanair lifting its passenger growth target for the year as it reports second quarter earnings that beat. The Irish budget carrier saying it received aircraft early from Boeing and travel demand remains strong. That right there is your Bloomberg brief. Up next on a programme looking beyond a December rate cut.
Absent new information that clearly changes the story and challenges this idea that risks to labour and inflation are coming into better balance, you cut December and then you take a timeout to assess in early 2026.
Up next is a man who thinks those cuts keep on coming. Andrew Hollenhorst of Citi joins us next. Coming up on the programme in the next hour, don't miss this conversation. Governor Miran voting for a 50 basis point reduction at the Federal Reserve meeting last Wednesday. He's going to join us to explain why and maybe get into some of the division on the rest of the committee as dissent cuts both ways in the last week. So that's the setup for the next hour. Equity futures this morning just about positive by 0.3% on the S&P 500. A lift on the Nasdaq as well, up by 0.6. Under surveillance this morning, looking beyond a December rate cut.
The logical compromise is what the logical compromise always was, which was absent new information that clearly changes the story and challenges this idea that risks to labor and inflation are coming into better balance. You cut December and then you take a timeout to assess in early 2026. That was my base case before, it's my base case now, albeit with somewhat less confidence.
So here's the latest this morning. Investors are awaiting private data this week for direction that could shape the Fed's path for interest rates. Andrew Hollenhorst of Citi writing, the very slow pace of hiring is likely to keep Fed officials cutting rates in December and into 26. Andrew joins us now for more. Andrew, good morning.
Good morning.
Did the meeting on Wednesday change your mind?
Didn't change my mind. I think it made very clear that there are big divisions across the committee. What we really need is data. With the government shutdown, we're waiting to get data. We're going to need that data to figure out what's going on in the economy.
Let's address the two dissents. Governor Miran, one way, the other way, President Smith. Who has the more convincing argument for you and why?
Well, I think there are a couple issues here. One is what's the balance of risk between inflation and employment? And in my view, it has become much more clear that that balance has moved further into balance, and you could even say that these downside risks to employment are maybe dominating. We've had, if anything, weaker than expected inflation data. The pass-through from tariffs has been less strong than expected. And then you look at the employment data, which is what we were writing about. Job growth is averaging only 29,000 per month in the data that we have up to August. Now, I'd love to have that September jobs report. We should have been getting the October jobs report, right? We really need that data to know what's going on in the labor market. But if it were me making decisions, and it's not, I would be more concerned about the downside risk to employment.
It's kind of interesting that when investors come on, they're talking about the reacceleration early next year from the tax rebates and some of the other efforts coming out of Washington. And we talk to economists, they're worried about a downtrend in the economy that's going to continue. Can you explain the divergence between these two?
Yeah, I have sensed that same disconnect. I think if you ask most economists, what we're seeing is growth that isn't falling off a cliff, but slowed down since last year. We have rates of growth in the first half of this year that were slower than in the second half of last year, depending on how you calculate it. And we have this big slowdown in job growth, weak hiring. If the hiring rate is low, even if we have a slowdown in labor force growth, and there's a whole debate about what that break-even rate of payrolls growth is, that means we're going to have slower income growth. If you have slower income growth, you're going to have slower spending growth. So this really looks like a slowdown, not a reacceleration. But you're right. If you talk to people involved in markets, I think there is an expectation out there that we can actually reaccelerate.
There is also an argument, and Jim Bianco was threading this needle, and it's a delicate one, this idea that if the Fed does cut rates more, it's not going to help the people who really need it as much as fuel some of the gains that we've seen in equity and bond markets that have really affected the upper echelons of the income scale. So how do you frame that? The idea that the financial transmission mechanism, for all intents and purposes, is diluted, if not broken.
It's a very blunt tool, interest rate policy. That's just a general issue that the Federal Reserve has to grapple with. If you cut interest rates, yes, that could lead to lower mortgage rates. That could boost housing prices, which, of course, accrue to those who own houses already. That could worsen inequality. But think about what's going on in the housing sector right now. We have house prices that were actually falling for multiple months. Now they seem to have stabilized a bit with lower mortgage rates, so I'm not as worried about what's going on there. On the other hand, cutting interest rates also helps boost economic demand. That helps address lower hiring rates. Who are those lower hiring rates hurting? That really is people at the lower end of the income distribution. People with high incomes tend to keep their jobs for long periods of time. It's not a problem if you're in a job right now. The layoff rate is actually low. It's if you're out of a job that you have a problem.
Andrew, what do you make of the Supreme Court going to hear oral arguments on IEEPA? If they strike this down as refunds to businesses, will this cause chaos just for the C-suite, or is this going to be a problem for the Federal Reserve to rethink how tariffs are impacting inflation?
Yeah, I think it depends a little bit on how the administration responds with policy. There are a variety of different tariff authorities that the administration can use and probably reimpose significant tariffs to bring tariff revenue back up to similar levels to what it's running at now. So I think from a budget perspective, this doesn't end up being a huge issue fundamentally. Having said that, we've been in a period of very low volatility in markets. We're not getting the economic data due to the shutdown. So this would be an event that would be a market volatility-inducing event, I think, where people would question, what do tariffs look like going forward? So uncertainty has been falling around that. I think that would raise uncertainty again.
What if the government doesn't open by the December meeting?
Yeah, that is a really interesting scenario and clearly something that Fed officials talked about a bit. What Chair Powell said is that there's this growing chorus to be cautious in that event where you wouldn't get data and we'd have the December meeting under those circumstances. Now, cautious could mean two things, right? You could be cautious and say, well, I should cut rates 25 basis points because I should be moving towards neutral. It sounded maybe more where the committee was leaning was in the event of no data and no sign in that we are getting weekly jobless claims, for instance, no sign of a major deterioration, maybe hold rates in December and then wait until January, March to make a decision. I'm very hopeful that the government's going to reopen by that time. I'm sure that Fed officials are also, so we'll have that data.
The December meeting has an extra wrinkle. Got to put out some forecasts. Last week was easy compared to what's in store in December. If you had to edit the SEP right now, what kind of edits would you take for 26?
Yeah, I think what I would be most interested in is what's going to happen with the unemployment rate next year. And again, that's going to depend on what do we see in the data if that data are released. If there's no new data released, then I think a lot of Fed officials could essentially leave their forecasts in place regarding what's happening with the labor market. And what Fed officials have emphasized, what Chair Powell has emphasized, is it's not so much what those point estimates are. Of course, they matter, but it's the risks around those point estimates. So right now, we're seeing this risk to the downside to employment. Is that realized in the data? We need the data.
I've heard this argument a few times. The outlook hasn't changed. The risks around the outlook has. Yeah. You mentioned jobless claims. Don't jobless claims support the idea that downside risks to employment aren't as pronounced as some people believe they are?
Well, I think they show us that they haven't been realized, right? If we were realizing the downside risk to employment, then we would see a spike in initial jobless claims. We would see people losing their jobs. We're not seeing that in the weekly data. So that is one comforting thing that we haven't in that jobless claims data that we're getting. We haven't had a major deterioration in the economy. But think about some of the other things that we've had in terms of signals on the economy. We've had the Fed's Beige Book, which is telling us that in many areas, people aren't really hiring. And in some areas, employment is actually going down. So that downside risk is still there. I think we haven't realized the risk.
So what's the committee's stance in December? Show me why I should cut or show me why I shouldn't?
I think it depends on which Fed official you ask, right? We heard from Dallas Fed President Logan. We heard from Cleveland Fed President Hammack. And they're basically saying, I need to see something in the data to know why I should be cutting further. I think for the committee as a whole, if you listen to Chair Powell, well, if you still think that you're modestly restrictive, and you think that risks to the outlook are balanced in terms of employment and inflation, you should be getting back to neutral. Do you need to cut at that December meeting? It's going to depend on the data. It's going to depend on whether that pace of job growth, is it still running at 29,000 per month? If it is, I think they're cutting. If we accelerate back up to something we're running more like 100,000 per month, that could be a scenario where the agreement is to stand pat. We saw last week, there's just big divisions, and Powell's going to have to work out how that consensus gets built.
Good luck to him.
Good luck.
Good luck to him. Andrew Hollenhorst of Citi. Andrew, thank you. Lisa, we're entering a window of a range of estimates on where neutral is, which is why this gets so much more trickier into December.
There's no risk-free option, as Jay Powell said in this past week's meeting, and that's because we are getting closer to that neutral sense. Some people say we're already there.
Coming up next, we'll catch up with Dan Greenhaus of Solus Alternative Asset Management. We'll speak to a man who does not think we're there. Fed Governor Stephen Miran is just around the corner, plus Amanda Lynam of BlackRock, Brian Belski of Humilis Investment Strategies. The second hour of Bloomberg Surveillance, up next.
If things get worse, the Fed will respond and cut aggressively.
They're threading a very fine needle between their two mandates.
Not sure where the gloom about the economy comes from.
We're going to have a real lag in information going into that December meeting.
We will get a December rate cut, but nothing in 2026 or 2027.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures entering November on a high and adding some weight to the October rally. Futures up by a third of 1% on the S&P, on the Nasdaq up by 0.6. Heading into this week, no payrolls, but plenty of data, ISM manufacturing, ISM services, and a key hearing at the Supreme Court this coming Wednesday,
which could potentially overturn some of the tariffs, or at least legal justification that the president has used. A real question here about whether this is a risk factor for bond markets. If the country isn't getting $400 billion of revenue each year from the tariffs it has on, does that create a real sell-off in long-term bonds? That if it's using this as justification for the deficit isn't that bad?
Well, also the other problem is that they have to start now refunding it. The chaos this could then be caused. $90 billion potentially going back to the C-suites. But then at the same time, the White House has a number of avenues they can take with 232s, 301. There's a number of different trade sections they can use to enact similar tariffs. It just will take that much longer. And then you have to wonder, does the Fed then look at this and say, well, we might not get this tariff-induced impact for months beyond if they need to rewrite how they're actually going to be adding tariffs on these goods?
The fear that so many people had regarding tariffs just hasn't materialized, particularly in fixed income. Lisa, you mentioned fixed income bonds. We've said this so many times. It was bond negative in April. 6 months later, it's bond positive. 10-year bond yields around 4%.
Yeah, it's a justification to keep buying bonds. The reason why people are saying you don't have to worry about the U.S. not paying its debts because it's getting a stream of income. The truth is, when you take a look at studies, both the inflation-related impact hasn't been as great as people expected, and frankly, the income hasn't been as great as people expected. When you take a look at the income from tariffs, the actual effective rate is something more to 12.5% rather than the 19% that it effectively would be. At the same time, companies haven't been passing it along, so it raises this question: do you discount that entirely and look at an economy that's incredibly confusing and incredibly bifurcated?
Bond yields this morning higher by just about a basis point. Coming up this hour, we'll catch up with Dan Greenhaus of Solus Alternative Asset Management as equities look to add to October gains. Federal Reserve Governor Stephen Miran joins us, issuing a warning over recession risks, and Amanda Lynam of BlackRock as big tech deepens its AI debts. We begin this hour with stocks climbing to kick off a busy month of earnings. Dan Greenhaus of Solus Alternative Asset Management writing commentary from a host of companies are supportive of the risk-on mentality. As long as they are saying everything is fine, I have little reason to think otherwise. Dan joins us now for more. Dan, good morning.
Good morning to you, sir.
Which companies are saying everything's fine?
I know there's all this concern about, you were talking earlier with Jim Bianco about the K-shaped market. I don't know, man. I look through earnings reports and I hear pretty good things. Obviously, you have the AI story, which we can talk about in a minute. But from the consumer standpoint, I use Visa and MasterCard, not to mention Capital One, American Express, et cetera. But I use Visa and MasterCard as real consumer blueprints. They're not just seeing restaurant sales or travel or sporting goods. They see obviously everything. And both of them had incredibly positive things to say about the consumer. No downturn really at all. I mean, obviously there's still issues at the lower income consumer. But when those two companies tell me, when they speak the way that they do, I have to take notice.
You know, I joked, and you probably heard that I call it cherry picking season because you can just pick some companies and tell whatever story you want. I'm with you. I'm following the same theme. Consumers are still spending, even though they don't feel good about the broader economy. We brought up with Chipotle. Now, I just wonder if that's a Chipotle story or if that tells you something about corporate America's ability to pass on higher costs.
So two things. I want to get back to the cherry picking season.
Please do.
Chipotle seems pretty clear to me to be an idiosyncratic story. I don't eat there regularly at all, although my daughter increasingly is doing so. But I have friends that ate there pre-COVID, and what used to cost them $12 now costs them $19. Not that there isn't inflation everywhere. And there's the people I talk to who eat at Chipotle regularly have a real sense of dissatisfaction, portion sizes, pricing, et cetera, et cetera. But I disagree with the idea that this is cherry picking season. Yes, if I want to highlight certain things, you can cherry pick. But what I have to do as an analyst, as an investor, as a hedge fund, what we have to do is look at the totality of the data. And you have to put it in sort of a hierarchy. What do I put the most weight on? What do I put the least weight on? And look at a broad swath of data, government, private sector, earnings, et cetera. And yeah, you can point to this or to that. But what I'm trying to do, and what I think most investors do, is look at it all together. And I think, again, when you look at it all together, the story is still positive.
Well, It's still positive, fueled by AI and fueled by the fact that a lot of these companies have really good, solid balance sheets. But what Torsten Slok was talking about with the K-shaped market was that profit margins have increased for the Magnificent Seven over the past year. They have declined for the other 493 stocks. I was looking at a Bank of America study over the weekend that came out and said excluding Amazon and Tesla, discretionary earnings are on pace to fall 2% in the third quarter versus some of the gains that you're seeing elsewhere. There is true discretion that is being shown by consumers. Does that worry you?
Sure, but to cherry pick, look at TJX and Ross stores doing quite well. Look at Ralph Lauren. Look at the auto companies, like the auto parts companies like O'Reilly and AutoZone. There is certainly, everything is not universally great. And a theme that I've harped on for the last year or two is but things are still good enough. And you're skeptical of what I'm saying.
No, carry on. I'm listening to what you're saying. I'm just thinking to myself, if that's the case, a rate cut might be a bigger risk scenario than it is beneficial if everything is doing just fine.
Well, hold on. So again, getting back to your interview with Jim Bianco, who I saw before I left the House, he was talking about what problem is the Fed trying to solve. And I don't think that's the right way to think. I mean, Jim is fantastic, but I don't think that's the right way to think about it. The question is the current Fed funds rate appropriate? I and others, I know Governor Miran is coming up after me, as he should instead of before me. 50 basis points might be too much, fine. But the question is whether the Fed funds rate is too high. And I think I and others think that it is a little too high. Now, we've gone some way to correcting that. But could another rate cut or two be warranted? I don't think that's crazy. Again, it's not about solving a problem. It's about putting the rate where it's supposed to be.
Square this circle. We need more rate cuts, but everything is really good and people are cherry picking if they see bad.
And you just did it again. You used the word need. Need implies there's a problem to solve. And I'm not saying the economy is weak. We need to reduce rates to stimulate demand, although it will help, as you mentioned, auto loans, consumer cards. I'm arguing where should the rate be? This is a whole separate conversation, and I don't want to front run Governor Miran, who can speak for himself. But where should the rate be? I think and have thought it should be a little lower.
How low?
I think certainly if you get down, I'm a little less sure now. We don't have the government data, and some of the tariff story might still come to fold. But when we were at 4.5, I was saying somewhere around 3.5 is probably where you could head and take a pause.
Since you were watching Jim Bianco, you also heard him talk about the fact that the Fed needs the government data, but doesn't think the market does. Have you been just fine mudding along without BLS data?
Yeah, I don't find. We were talking in the green room before. I have everything I need, Andrew Hollenhorst and I have everything I need. And again, you get National Association of Realtors, National Association of Home Builders. You get all the private sector data. Would I like more data? Of course, but I have plenty.
Payrolls just hasn't been particularly relevant to the direction of the market. Lost count of how many times we brought that up on this program. Even if we had payrolls and it carried on decelerating, would it be instructive for the direction of the S&P 500?
The AI story is so dominant right now. On TV, we always debate what's more important, AI or the Fed, AI or the Fed. I think the answer is unquestionably AI. And the best part about this last earnings season is you're starting to see it get used in a productivity-enhancing way that you haven't previously. So real quick, Amazon talked about Rufus now doing $10 billion of incremental sales. Google said people are searching more. Facebook talked about a 5% increase in engagement. Microsoft, the Copilot adoption. But when you step away from the big companies, you get a ton of other companies. In terms of sales, Caterpillar, power generation sales up 1/3. Amphenol, sales up 130%. Vertiv's backlog is up 30%. Teradyne said second half revenue is 50% higher, will be 50% higher than they thought 3 months ago. So you're seeing this work its way throughout the economy in terms of sales. And then PPG said they designed a new clear coat product using generative AI and their own internal data. Visa talked about an AI-generated commercial that they're doing, something that Colgate talked a lot more using AI content. And there's any CoStar and Booking and Hilton Grand Vacations all talked about AI helping keep people, increase engagement, drive sales. This is having a real tangible effect on the economy right now.
So is the cheat sheet if a company mentions AI 3 times on their earnings call, buy the stock. And if they don't mention it, avoid at all costs.
I don't think that's a fair simplification of what I'm saying. There are plenty. When I go through the transcripts using Bloomberg's fantastic document analyzer,
thank you,
form, there are a number of companies that just say the word AI and don't really have anything to say about it. Oh, we're going to use it. I'm talking about companies that are like, again, PPG designed a product. Visa's using it to do a commercial. A number of companies are talking about engagement going up, time spent, more views, more listings viewed, et cetera, et cetera. There are some companies that are not just saying it, but are actually implementing it in a tangible, observable, measurable way.
We got to go. You went first, but he gets more time.
Understandably so.
Good to see you. So you should. Dan Greenhaus of Solus Alternative Asset Management. Thank you very much. Let's get you an update on stories worldwide. Here's your Bloomberg brief. Our first story, China criticizing the Japanese Prime Minister Sanae Takaichi for meeting with Taiwanese officials on the sidelines of the APEC summit. Takaichi posting on X about the talk, saying she looks forward to deepening cooperation with Taipei. Elsewhere, President Donald Trump saying he will not attend Supreme Court arguments this week over the legality of his tariffs. The court will hear on an appeal of a lower court's ruling that many of his Liberation Day tariffs exceeded the president's emergency powers. And finally, the US allowing Microsoft to ship the latest NVIDIA chips to the UAE for the first time. Microsoft confirming the news to the Financial Times. The announcement comes after President Trump struck a deal back in May for the UAE to build a new AI data center campus in Abu Dhabi. And that's quite the development.
This is quite a development, and you see the Microsoft executive, CEO, coming out and telling the Financial Times we had to go through really strict requirements in order to get those export licenses, and now they're starting to flow. Next up, the Crown Prince will be in Washington, D.C. this month, and I imagine you're going to see more of those export licenses starting to flow out of the Commerce Department.
NVIDIA up again this morning. Up next on the program, recession risks.
We are in good shape, but I think that there are sectors of the economy that are in recession.
Up next, we'll catch up with the Federal Reserve Governor Stephen Miran from New York City this morning. Good morning. Live from New York City this morning. Good morning to you all. Just a flavour of the price action, a snapshot this Monday morning. Equity futures positive by 0.4% on a 6-month winning streak on the S&P 500, the longest going back to August of 2021. On the Nasdaq 100, it's month 7, looking for month 8, up by 0.7% this morning. That's the equity story. And in the bond market, yields higher by a single basis point across the curve. 2s out to 30s, 10s this morning, just north of 4% at 4.09. Under surveillance this morning, in focus, recession risks.
I believe that we are in a transition period here. If we are contracting spending, then I would think inflation would be dropping. If inflation is dropping, then the Fed should be cutting rates. We are in good shape, but I think that there are sectors of the economy that are in recession.
So here's the latest this morning. Federal Reserve Governor Stephen Miran warning of a possible downturn in the economy if Fed policy remains restrictive. Miran taking the most dovish side of a divided Fed, casting the lone vote for a 50 basis point rate cut at the Fed's October meeting. I'm pleased to say for his first broadcast interview since that conversation at the Federal Reserve, the Fed Governor Stephen Miran joins us now for more. Governor Miran, good morning.
Good morning. Thanks for having me.
Hey, it's good to see you, as always, sir. So let's spend some time. How did you approach the committee meeting just last week, and what was the argument for 50 basis points?
So I approached it the same way I approached the first one, which is that I think that the Fed is too restrictive. I think that neutral is quite a ways below where current policy is. And given my rather more sanguine outlook on inflation than some of the other members of the committee, I don't see a reason for keeping policy as restrictive for a long period of time as we are. The longer you keep policy restrictive, the more you run the risk that monetary policy itself causes a downturn in the economy.
What was interesting about last week, as you know, is the dissent cut both ways. We also had this argument from President Smith of Kansas City Fed, who put out a long statement. I've cherry-picked a quote, forgive me. I see the stance of policy as being only modestly restrictive. Financial market conditions appear to be easy across many metrics. When you heard that kind of argument, what was the counterpoint? to what he's seeing in markets?
Yeah, so I'd say a couple things. First of all, I'd say the financial markets are driven by a lot of things, not just monetary policy. They're driven, of course, in part by monetary policy, but there's a lot of things that drive financial markets. For example, I think on this program, you probably spend a lot of time thinking about AI and new technologies. If you have AI or a new technology, it could push financial markets higher, which would look like an easing of financial conditions, but that doesn't necessarily tell you anything about the stance of monetary policy. Indeed, very often in response to a supply shock, or positive supply shock, although of course it depends what kind of supply shock, you might think that the appropriate sense of monetary policy would be lower and not tighter, all else equal. But of course, there's a lot of sort of what ifs and thinking about the type of the supply shock. But I think that it's a mistake to look at financial conditions and sort of conclude something automatically about the stance of monetary policy. And I also want to point out that some of the financial conditions that look the easiest, things like the stock market, things like sort of various parts of credit spreads, those are not necessarily the financial conditions that feed the most into economic activity. Yes, the stock market and credit spreads matter. They matter a lot. But then you sort of think about something like housing. I think housing matters a lot more for the cyclical position of the economy. And it's not that these things don't matter, but it's that they're only part of the picture. And if you look at financial conditions that affect housing, I think they're quite tighter. You look at financial conditions that are affecting parts of the private credit market, that also looks tighter. And I wonder if what we're seeing now in some of the distresses that you see in private markets means that financial conditions have actually been tighter, but it's been masked by the fact that we don't get marks for those on a regular basis.
So, Governor, I think I want to give you some time. I think we should give you some time on a central argument of yours that this year you believe policy is actually passively tightened through 2025. I don't think that's an argument I've heard many people make. Can you just spend some time fleshing that out? What do you mean by that?
Sure. So my perspective is that there's been a number of shocks that have hit the economy, driven in large part by economic policy from not from the Fed, from outside of the Fed, that pushed neutral rates higher last year and lower this year. And so I think if you look where my neutral rate is, it's not that I'm out of bounds for where the rest of the committee is on neutral. It's just that I flipped from having one of the highest neutral rates last year to now one of the lowest neutral rates. And that's driven by things like population growth, right? It's driven by things like fiscal deficits. And if you think about population growth, right, that's normally considered to be one of the biggest drivers of neutral rates. And it's part of the reason why people think that neutral usually moves very, very slowly, because population growth changes only very, very slowly as new technologies and cultural trends drive people to have fewer kids over time. But we experienced in the last few years 30 years worth of population growth change in only 3 years. Right? When you look at the rate of population growth, it changed more in the last 3 years than it did in the previous 30 years. In both directions, it round-tripped completely. And so if the drivers of changes in the neutral rate accelerate over time, it would only make sense to me that the neutral rate itself would change more rapidly over time as well. And so that's pushed neutral higher last year and lower this year, which means that policy is passively tightened. Because what matters for the stance of policy is where you are relative to the neutral rate. And if neutral is here and policy's up here, you're very tight. If neutral's here and policy's down here, you're very loose. But if you stay where you are and then neutral goes down, you've passively tightened because the neutral rate has shifted. And so policy has grown tighter over the course of the year. Now, it's not the case that you would expect to see a significant downturn in the economy immediately as a result of that, because monetary policy works with lags. It hits the economy with long and variable lags, as we all know. But if you maintain that very restrictive stance of policy for a long period of time, you really increase the chances that those lags come to manifest and that monetary policy then itself induces a downturn in the economy.
Why wasn't your dissent bigger? You were talking about a 50 basis point cut that you would have preferred to see in the September meeting. Why didn't you go for a 75 basis point cut dissent last month?
Of course. So, look, I think that we're a fair way from neutral, and I think that we could get there a bit faster. I could imagine getting there in a series of 50 clips. I don't think it's the case that we need to get there in more than that, because I don't think the economy is dysfunctional right now. I don't think that financial markets are dysfunctional right now. I don't think we need to move even faster than that for those reasons. If I did, then I would have no problem voting for bigger cuts. But I think sort of getting there in 50s instead of 25s is fine.
So you would be open to dissenting again for a 50 basis point cut if the rest of the committee wasn't around for that next month, or in December rather?
Yeah, well, I don't want to commit to that, because a lot can happen between now and the next meeting. We're getting a lot of data, I hope, between now and then, not only data about the near term, but data about the recent past as well that we don't have. So things could change, but if things play out according to my forecast, then yes, I would.
Governor, do you think your advocacy for a 50 cut is hardening the opposition to cuts at all?
I don't think so. I think everybody is doing their own analysis of the economy and inflation in the labor market and financial markets too, and coming to a conclusion. And I don't think anybody is necessarily changing their mind sort of to not support a cut because I want to cut more.
Is there a lot of discussion at the Fed about the fact that you're all doing your own analysis, but what data are you all using if we're still in the middle of a government shutdown, 34 days today?
Yeah, so there's a lot of talk about that. Let me say a couple things about that. First of all, it's my perspective that being excessively data dependent makes you backward looking because the data are always backward looking because of collection lags, because the amount of time that you're doing comparisons over, right? And given monetary policy takes lags to hit the economy, you want to be forward looking. So you want to make policy based on your forecast. Now, there are times when you might not have a lot of confidence in your forecast, and so you need to be data dependent. But you should be data dependent only to the extent that you don't have confidence in your forecast. My perspective is that we know the size of the shocks that have hit the economy this year. Things like population growth, that's a known quantity. We know what it does to the economy. We know what it does to neutral. We know the size of that. It's not a mystery. So therefore, I have a lot of confidence in my forecast. And therefore, to the extent that we would get data that would make me change my forecast, I would then change my policy outlook, right? So the question is, am I missing data because of the government shutdown that would lead me to change my forecast? And given so much of my forecast for inflation depends on the housing market, and depends on the housing market, I would assume that I would see that in the reporting that Bloomberg and others do, even if I'm not getting data in the short term. Now, something like that lasts a couple of months, right? Can I continue to sort of have this degree of confidence if we go 6 months without data? Absolutely not. So I do think this is something people are attentive to. And there's also alternative data, as you guys are aware. I find the alternative data on inflation to be not super useful. I do find it to be more useful on the labor market. And when you sort of look at alternative data on the labor market, you see data that's consistent with continual ebbing of demand, which again is a signal that policy is too tight. If the decline in hiring was a result of negative supply shocks from immigration, you would see higher wages, and you would see firms and people answering surveys in a way that indicated that jobs were plentiful or it was difficult to find workers from the firm perspective.
You pointed to developments in private credit as well as evidence that we're restrictive. Perhaps it was the fault of our peers that this didn't come up much at the news conference. I was somewhat surprised. Did it come up much in the meeting, the two-day meeting last week?
Well, I mentioned it at the meeting as a reason why it was potentially a mistake to make very confident inferences from the stance of equity markets to the stance of monetary policy. But other than that, I think that sort of folks were focused on private credit as a financial stability risk, and sort of thinking about how much should we care about this? What are the risks? What are the risks? Where could this go? Just sort of analyzing it from a financial stability perspective. Whereas I was making the point as well that there's a chance that because we don't get marks on these things very frequently, that distresses are actually greater than we thought they were. Especially when you think about the share of credit that has been created in private markets in the last few years. So it slowed down recently, but over the last few years, it's been a greater share of credit that's been extended to the economy. And so it could be that we're just not seeing it.
Do you think we're missing something here? Because so many guests come on the program and say it's idiosyncratic, just signs of isolated fraud, not a big deal, not systemic, not broad enough. Do you share that view?
So, look, I think that probably at the end of the day, that's what it is. However, I do want to make the point that when you get series of seemingly uncorrelated, non-systematic issues like that, it can be an indication that monetary policy is restrictive. We've seen this in the past. When you have a series of seemingly uncorrelated credit problems that had been masked for a while and then suddenly come to light, it tells you something about the stance of monetary policy.
Governor, it's good to see you. I know you've got a flight to catch, so thanks for making some time for us this morning. We appreciate it. Thank you, sir.
Thanks for having me.
Governor Stephen Miran there of the Federal Reserve on the decision just last week and that descent to push not for 25, but to push for 50.
What he just was talking about there with private credit is really interesting, and it's nuanced. It's not just about cockroaches. It's about the credit risk being in an unseen place. And so people can be more sanguine because they're looking at it in the old places, not the new one where it might be actually accumulating.
We'll talk about credit next on the program. Amanda Lynam of BlackRock joined us as big tech takes on more debt. That conversation up next. Stocks this morning positive by 0.3% on the S&P 500. On the Nasdaq 100, higher by 0.6. About 2 hours out from the opening bell with your morning movers. Let's cross over to Danny Berger for more. Hey, Danny.
Hey, John. It has that feeling of deals Monday coming back. Starting in AI, another AI deal. This time, it is Microsoft buying cloud from Miran, the Australian-based company, a $9.7 billion deal. As part of that, they'll get access to NVIDIA processors. And as part of it, Miran has agreed to buy some of the equipment for the data center from Dell. So you can see Dell shares are up 4.4%. In another deal announced this morning, Kimberly-Clark will be buying Kenvue. That's the maker of goods like Tylenol. Shares of Kenvue surging 19% off that deal. Kimberly-Clark falls. Kenvue has been struggling since it was spun off from J&J. It's had a lot of activist investors swirling around, the most recent drama being from President Trump and his comments about Tylenol. So that will certainly introduce a twist as Kimberly-Clark pursues this deal, valuing the company at $40 billion. Finally, just a little bit of sell-side action to round things off. UBS upgrading Cisco, shares rallying off the back of that, saying it is about AI-driven demand. That AI infrastructure demand will be good for Cisco. Their price target implies a 20% rally. John.
Danny, thank you. That stock is up by 1.4%. More from Danny in the next hour. On our radar this morning, China suspending some rare earth curbs and terminating investigations into U.S. chip companies. The move coming after the White House announced a one-year pause on some reciprocal tariffs on Chinese goods. Elsewhere, staffing issues triggering multiple ground stops at Newark Airport in New Jersey this weekend. These stops causing delays and forcing the cancellation of more than 100 flights. Air traffic controllers are working without pay during the government shutdown. And finally, the Federal Reserve Governor Stephen Miran defending his call for bigger rate cuts. Miran saying some of his fellow board members are overly concerned with inflation and tighter policy could bring the risk of a recession.
I think that the Fed is too restrictive. I think that neutral is quite a ways below where current policy is. And given my rather more sanguine outlook on inflation than some of the other members of the committee, I don't see a reason for keeping policy as restrictive for a long period of time as we are. The longer you keep policy restrictive, the more you run the risk that monetary policy itself causes a downturn in the economy.
Governor Miran did not buy the argument on financial conditions that came from the Kansas City Fed and that dissent in the other direction in the last week.
His argument was really interesting. He's saying, look, you can't look at overall conditions and some of the AI boom and the related tech rally that you've seen in stock and bond markets as evidence of a real loose financial conditions type of environment. He pointed to private credit. And he said, look, there is weakness that is emerging, but it isn't visible in the same way because that has been the expansion. So in the past, we might have been looking at things like high yield bond spreads. We can't do that as sort of the arbiter of weakness in the same way because there is this buffer in the private credit sphere that is not as visible and might be experiencing some weakness.
And he says the problems can actually come about because of stance of current policy. I also thought it was interesting, he said he finds alternative inflation data to not be super useful. So when it comes to the government shutdown, he thinks he can almost muddy along, it felt like, when it comes to what's going on in the labor department in terms of where the hiring and firing is. But he says in terms of inflation, that's a problem. So it might be really difficult for this Fed if the opposition is more focused on inflation right now and you do not have any more CPI data.
We can still focus on the labor market this week. Difficult to focus on inflation. I'm with you. This week, ISM, manufacturing services, the employment components of that, ADP, job openings too. I know that's somewhat backward looking, of course, a couple of months backward looking, but we've got something at least the coming week.
And frankly, a lot of people have said, look, it's still this low fire, low hire churn dynamic. At the same time, you do see signs of weakness. And you do say, OK, Chipotle is one example where young people aren't spending $20 for a burrito anymore. But on the other hand, you are seeing this even in things like Kimberly-Clark. People are being discretionary when it comes to what toilet paper they want. Maybe they don't want 2-ply. Maybe they're just going to go for 1-ply.
I'm not going to weigh in on that at all. I'll take a miss. I think we've all got our own views on that, of course. Very personal. Ramo, where are we going? Equity futures on the S&P 500 this morning, just about positive, building on the big gains for the month of October as we come into the month of November. Turning to tech, Alphabet returning to Europe's debt market for the second time this year, looking to sell $3 billion in euro-denominated bonds to fund its AI expansion. The announcement coming after Meta sold $30 billion of corporate bonds just last week. Amanda Lynam of BlackRock joins us now for more. Amanda, good morning.
Good morning. Thank you for having me.
The amount of debt that's coming to market from tech.
Yes.
This is a big development we need to track. How are you and the team tracking things?
So thank you for having me. It is, I would say it's a pretty big paradigm shift. If you look at data from Dealogic, U.S. IG tech issuance has already surpassed all of the full years on record so far in 2025. So this is something that is actually gaining further momentum. We think there's more room to run. There are a couple things that I would note. One, in U.S. IG, we look at gross issuance and net issuance, and we also look at gross leverage and net debt. The reason I mention that is that a lot of these companies, not all of them, but some of the largest companies are actually still in a net cash position. So they're issuing debt, but they actually still have more cash on their balance sheet relative to debt. Now, the historical precedent for that was prior to the 2017 tax reform, a lot of that cash was trapped overseas. So US IG companies used to allow their cash to build overseas, and then they would have to pay taxes on if it were repatriated. Now that's a different backdrop. I say that because there's a lot of focus on kind of the releveraging of the tech sector, but our view is that there is a very long way to run, because not only is gross leverage really modest in this sector, net leverage is actually negative, because again, they're still in a net cash position. So what that means is a lot of this CapEx will be funded by a combination of public debt markets, US, Europe, private credit, maybe some fiscal plans as well. But there's a lot of room to run. I think the binding constraint will be, one, is there over the next few years a disruptive technology that kind of derails that, or is there ongoing true demand under the surface that kind of builds that productivity and that economic value added? And then the binding constraint will be the rating agencies. This actually reminds me a lot of the pharma industry back in 2009. There was a paradigm shift of a lot of mergers between pharma and biotech. A lot of companies actually took active downgrades to their debt ratings purposefully, and it actually, on a smaller scale, reminds me a lot of that.
You know, there's this discussion that's increasingly nuanced, which is there's not a fear that Meta is going to go bankrupt in the near term. There's not a fear that Amazon or Alphabet is going to really run into financial problems. There is, however, a feeling that there are an increasing number of related companies that are levering up in order to build out data centers or build out other types of infrastructure that are going to run into problems. I mean, how much are you worried about that leverage that is also building in tandem with the behemoths?
Well, I think, again, going back to the point, these are companies that are generating a significant amount of cash. They have a lot of liquidity on their balance sheet. And I think they're making a calculus that they have to invest in this paradigm shift. And they really don't have an option not to, right? So there may be winners and losers of this. Perhaps the folks that are investing, they may not be the biggest beneficiaries of the technology, right? There may be other parts of the value chain that benefit more. But I think the fact of the matter is the market is comfortable. Again, it reminds me a lot of pharma and biotech. A lot of times management teams are making bets on drug discoveries that haven't happened yet. They're issuing 30 or 40-year bonds after patent cliffs expire. These are just bets on management teams that they will see through the new regime and have to navigate through it. But I think there's a lot of financial cushion in this sector. And I don't think we're anywhere near the point where investors are thinking of stopping funding it, because you can see the demand from the new issues.
Stephen Miran was just on, Fed Governor, talking about how financial conditions don't necessarily tell the whole story and that they can mask a lot of pain that you're seeing elsewhere. And he pointed to the private credit space, and he said that that has been the biggest growth area, and that is an area where you don't see visibility into the marks that you have currently, and you could have some potential pitfalls, and we are seeing anecdotes to that degree. Not saying are there cockroaches that are going to undermine the whole system, but do you think that's a valid argument that high-yield bond spreads aren't going to be the canary in the coal mine? It's in the private credit sphere, and it's not very visible.
So I agree with his point that aggregate financial conditions are not representative of everything that is going on in the economy. I don't think it's limited to private credit, however. If you look at, for example, triple C's in high yield, median interest coverage is already below 1 times, right? So that is a really non-existent financial cushion in aggregate for a sector to navigate a higher cost of debt. You see it in commercial real estate. Parts of commercial real estate, Class C office, haven't kept up. You see it in consumer credit, ages 20 to 29 cohorts with student loans. They're not homeowners. They're not equity owners. They're really struggling. So I think the point is that, yes, financial conditions in aggregate, using an input of 5 measures, have eased since the April peak. But under the surface, whether you look at leveraged loan borrowers, high yield, private credit, commercial real estate, consumer credit, there are pockets that haven't kept pace. Again, it speaks to the bifurcated and dispersed worst economy that we have. So I would agree that actually financial conditions in aggregate don't tell the whole story. I don't think it's isolated, however, to private credit. I also think what he was pointing to is that private credit has changed the transmission of monetary policy through the economy. Private credit has stepped in historically when other traditional parts of lending have pulled back, bank C&I lending, the debt capital markets. In our view, that's not a bad thing, right? Because private credit has filled a void. There are 44,000 private companies across the US, the UK, and Europe. And so it's a significant economic opportunity to fund those companies.
The counter-argument to all of that, Bramo, if you really think about it, is that the boom in private credit came in a rising interest rate environment. So can you really draw a link between Fed policy and the direction of private credit? Because it didn't work one way. Why does it work the other?
This is the issue, right? At a certain point, you could argue if they're feeling weakness, that's not a bad thing because you're still seeing it deploy. I mean, Apollo and Ares reported earnings today, and the earnings are doing great. So it's not as though they're about to struggle. You have to wonder that counterfactual that you're just talking about. Is that a positive in terms of the resilience of the economy?
This is the point, Amanda, that Lisa's been really hitting the drum on repeatedly. The use case of lowering interest rates. Right. What's it addressing? What's the channel?
Right. Well, actually, I think it's a great point. If you look at, say, going back to the leveraged loan market, leveraged loan defaults peaked in November of 2024 at 7.7%. That's a really high number. That's on pace with the pandemic, and that's issuer-weighted Moody's, right? But the point is that we've already had some incremental funding relief for floating rate borrowers thanks to the 150 basis points that the Fed has already delivered. I do think there are pockets of the market that would welcome that. If you're a younger consumer, you have floating rate credit cards, you have student loans. Yes, of course, every incremental cut helps. But in general, I think we feel comfortable that we're kind of past peak interest rate headwinds. We're probably past peak trade policy uncertainty. And we think we're probably on scope for a reacceleration in growth. And that leaves us comfortable with credit risk.
Do you think that if the Fed were to cut rates, it would force you to take risk you're uncomfortable taking in order to get the same kind of yield?
I do think there is a delicate trade-off between the yield on offer in a wide range of corporate credit markets and investor demand. So, for example, U.S. IG yields are now below 5%. High-yield yields are now below 7% in aggregate. I do think in a structurally higher yield environment, there is a bit more demand for spread-based product. But in terms of lenders kind of throwing caution to the wind because rates are falling, you have to keep in mind that especially in the private credit market, these loans are made and are staying on those lenders' balance sheets for the life of the loan. Very different than, say, in the financial crisis when they were syndicated out. So the risk calculus, to me, isn't going to be buffeted by an incremental 25 or 50 basis points of rate cuts.
Amanda, good to see you. As always, thanks for being here. Amanda Lynam there of BlackRock. With equities this morning positive by about 0.3%. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Energy Secretary Chris Wright saying U.S. nuclear weapons testing will stop short of actual warhead tests for now. President Donald Trump last week ordering the Pentagon to start testing nuclear weapons in response to other nations' programs. Elsewhere, Treasury Secretary Scott Bessent saying SNAP food benefits could restart as early as Wednesday. Two federal judges ruling Friday that the Trump administration must use emergency funds to pay the benefits, which help feed 42 million Americans. And finally, Egypt opening its $1 billion museum showcasing the wonders of the ancient past. The Grand Egyptian Museum is the world's largest museum focusing on a single civilization and houses over 100,000 artifacts from across 7 millennia. Very cool. That's your Bloomberg brief. Up next, looking for an everything rally.
Right now, it's the AI trade. The direction of travel is up. It's an everything rally here. For investors, yes, this year ends likely higher.
That conversation up next with Brian Belski of Humilis Investment Strategies. Live from New York City, you're watching Bloomberg TV. Live from New York City, welcome to the program. Equity futures on the S&P 500 firmer here by about 0.25%, on the Nasdaq 100 up by 0.6. If you switch up the board and turn to the bond market, plenty of data through the week. ISM manufacturing, services, ADP, JOLTS, yields up 2 basis points, 4.09%. Two-year bond yield shifting higher last week. Chairman Powell pushing back against the prospect of interest rate cuts. Yields up another 1 basis point at the front end of the curve.
Yeah, and this question of if it is foggy, do you slow down? Or is it not so foggy because we get other data and they can kind of go with that? Look, We didn't get a lot of information, except I keep going back to what Bob Michael told you, which is essentially this is a Fed Chair Powell that has lost control over the Federal Reserve. And that was the biggest takeaway from last week.
A lame duck season for Chair Powell into May of next year. And at Savannah's this morning, we turn to the equity market looking for an everything rally.
Right now, it's the AI trade. The direction of travel is up. It's an everything rally here. It's now taken on a life of its own as the Fed cuts into increased earnings estimates and an economy that is not just stabilizing, but growth estimates are ticking up higher for next year. And you're in this you're in a liquid situation. For investors, yes, this year ends likely higher.
So here's the latest this morning. Big tech putting the S&P 500 on a 6-month winning streak. Brian Belski, the founder and CEO of Humilis Investment Strategies, saying stocks have more room to run. He's calling for the S&P 500 to hit 7K by year end. Brian joins us now for more. Brian, good morning. Good to see you, sir.
Thank you so much for having me.
And congratulations, unshackled by corporate culture. What's the new approach going to be?
Well, it's going to be the same old song and dance for Belski. I'm just going to continue to do my best for my clients and their clients, and we're going to try to give our best market views. And, fortunately, unfortunately, this is my 36th year doing this. I started when I was 8 years old, clearly. And I've always said this, when you look at the market, I've always tried to think about how you're going to invest in the market. So many people that do what I do, they want to make the big market call and the index call. And so our first rule of investing is like stocks lead earnings, which lead the economy. And the stock market is a market of stocks. So for instance, when I look at tech, and I've been bullish on tech for a long time, what are the parts of tech where I want to be in? And rule number 3 of investing is you don't have to know everything. So many people in our business, they think they know everything. They need to be the smartest person in the room. So our tagline at Humilis is investing with conviction and humility. And the conviction part of it is, if there's 500 stocks in the S&P 500, and we run a large cap focused portfolio, we own 50. I think I have pretty good knowledge of the 50, the 100, the 450. I don't need to know all of those. So that's kind of how we've thought for all these years.
What do you need to know right now? What are you focused on?
Well, in my notes preparing, I'm a little bit worried that there's too many bears or too many bulls right now, and I'm very self-deprecating and I think about Belski. You're starting to firm at the top of the market. Well, for one, I don't think the top of the market's here. I mean, we've been on record since 2009, 2010 that the U.S. stock market has entered a 25-year secular bull market. People thought we're Pollyanna and always bullish and blah blah blah. In that time period, from then until now, we've had several cyclical bulls, cyclical bears. We're going to have another cyclical bear before the end of this as well, everybody. But everyone kind of jumping on top here. I think that's a little dangerous. But at the end of the day, we're investors. And so what we're going to continue to do is run value money, run dividend growth money, run small mid-cap money. And Alicia's right in the hit before we spoke. We are going to see a broadening out of the market. I think we're heading into Goldilocks. I think we're heading into where you have to own a little bit of everything, not just tech, not at the forsake of selling tech, but continue to be a fundamental bottoms-up investor. Let the market do what the market does.
So can you develop that, especially given the fact that you're seeing profit expansion disproportionately among the big tech players? It hasn't been in the discretionary shares to the same degree. So even when you look at the fundamentals of a lot of these companies, what gives you confidence that's going to shift, and that could be leadership?
So one of the things we've looked at for decades are earnings revisions. We use a diffusion index, Lisa, where we look at FY2 versus FY1 and the relative change in earnings. That's what kept us bullish all this year. We're starting to see a relative improvement. Remember, you don't buy at the top or sell at the bottom. When you start to see things improving, and we're seeing things improve on the other area within the other areas in the market in terms of broadening out. With respect to the cyclicals, is a great question. So if you're heading into a period where 10-year treasuries are going to be more steady, and a period where you're going to have a broadening out of the market, we want investors, in the way that we're looking at portfolios, we want to become more cyclical in consumer discretionary and more cyclical in industrials. If you take 2 steps back and look at where the performance has been in consumer discretionary, especially this year, it's all Tesla and Amazon. And more defensive areas like TJ Maxx, great company, we've owned it for a long time, but I think we want to get a little bit more cyclical in our consumer discretionary holdings. In industrials too, we've had a great run in some of the international industrials, but I think it's going to be more domestic That's what's going to, I think, do much better.
I love that you've always been called the biggest bull on Wall Street, and you start a fund that basically means humble. And you're coming out here and you're talking about a price target, I think, of something like 7,000 for the end of the year. I'm just wondering, could you see a price target for the S&P 500 at the end of this year and next year that isn't far away from where we are now, but potential for real outperformance if you go to some of the laggards of the past year? So, believe it or not, I mean, we are very convicted in what we say and how we communicate.
I'm shocked.
Shocked, right? We say what we mean what we say. We, in our entire career, have set up analytically and personally to underpromise and overdeliver. If you put out a big number, it's always hard to meet that. We've said very clearly, we said it during COVID, and we said it again this year with all the silliness with respect to the tariffs. Market targets are an academic practice. You aren't, in life, you do not run your life through a spreadsheet. You run your life through what's happening, right? And so I think that's where many of my cohorts got wrong. We put out a 7,000 bull case in our year ahead piece that we published last November. We said the bull case for 2025 was 7,000. So we've been there since November. Now the bull case is beginning to shape up. Earnings, as you said, are starting to go. The operating performance of companies in terms of return on equity, return on invested capital is beginning to turn. That looks all really, really great and all part of our process for several years. So there's no doubt that the market's probably going to eclipse that 7,000. But if you go back into the historical normalcy, if we can ever be normal in this business again, I think we're going to head back into, at worst, high single-digit, low double-digit performance, 3.5 to 4.5 on the 10-year Treasury, double-digit earnings. That's a pretty good place for stocks. And I think as investors kind of come back into really the best house in an improving neighborhood, the U.S. is the best house in an improving neighborhood, used to be the best house in a bad neighborhood in terms of the rest of the world. I think investors are going to calm down and use equities as a place for stability relative to their other assets.
When you say silliness of tariffs, do you mean tariffs are silly, or do you mean the about face we saw from the administration?
I'm thinking the silliness in terms of the reactions from investors. So, for instance, we were at BMO at the time, who's been an amazing partner for the last 13 and a half years. It was just an amazing place to be for all that time. And we were literally receiving emails and calls from advisors in Canada saying, their clients want to sell U.S. And what we said in a research report we said, we own what we own. We own what we own. If the market goes down and these stocks go down, we're going to buy more because we believe in the names that we own. And so that created a situation where fear was driving things. You should never live your life by fear, and you should never run your portfolio by fear. So that created, again, very humble to say that was our best quarterly performance in the history of running money, second quarter this year. And so we think that anytime you do that, so the silliness is exactly that in terms of this exogenous type of talk.
Can I jump in, Brian? What do you think really drives sentiment? National pride or price action?
That's a really, really great question. Well, remember, if you take two steps back and look at what's happened, and we're becoming more populous around the world. And I think sentiment is driven by, again, life is like investing is like life. It's not so much what's happening in terms of the stock market. If you walk down the street, and our great partners in Canada, you walk down the street in Bloor Street in Toronto and you say, hey, did you know that the Canadian stock market is outperforming the U.S. stock market? Canadians go, oh, I don't know, I didn't know. They have no idea because they're reading the Globe and Mail, they're watching the TV, they're scared. So it's sentiment. And then they're talking to we're having Thanksgiving in the United States coming up. People are not going to understand that the stock market's at all-time highs. I think 2 generations from now, my grandson's children are going to be talking about this stock market. They're going to be talking about the stock market, that this is one for the generations, that the majority of people, remember, the majority of people between 2009 and COVID missed this market.
Yep.
They missed it.
Looking forward to tracking it with you.
Thank you so
Congratulations, sir. Thanks for being here.
Thank you.
Thank you. Brian Belski of Humilis Investment Strategies. When he called me up and we talked about this new name, and I said, well, what does it mean? And then he told me, I burst out laughing.
Well, because he's very bullish, he's got a lot of conviction, but humble. That's how I think of you. I think of you as a humble, restrained person.
Convicted is how I think of
Yes, absolutely. And right, frankly, a lot of the time.
Particularly over the last 10 years, that's for sure. Coming up on the programme, Mike Wilson of Morgan Stanley, Jed Dorsheimer of William Blair, Nancy Lazar of Piper Sandler, Bob Michael of JPMorgan Asset Management, the third hour of Bloomberg Surveillance. Up next.
I think generally people are pretty optimistic.
You need to own the winners. Everything we're doing, I think the rest of the world should be copying.
When we look at the rest of the stocks in the S&P 500, there are some cracks.
In the near term, caution is warranted.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores look like this. Into November on a 6-month winning streak on the S&P 500, adding some weight to that October rally. On the S&P up by 0.25%, on the Nasdaq up by 0.55. Lots of data in the week ahead. ISM's manufacturing, services, ADP, job openings. A Supreme Court hearing on the future of tariffs worth listening to this coming Wednesday. But just moments ago, this headline dropping from Alphabet, that they're kicking off a multi-part dollar bond sale. Now, I'm losing track of how many debt sales are coming from big tech right now. Tapping this bond market big time to fund some big AI hopes and dreams.
Unprecedented in both the size and scope related to AI, and frankly, unprecedented when it comes even to the investment-grade corporate bond market. We are seeing unbelievable deals coming to the fruition, and a real question here of the changing nature of the tech trade. It has gone from a no-leverage, low asset-light type of structure to one that is debt-intensive, and that requires a real build-out. At what point does this get concerned, or at what point is this just the way things have to go?
Lisa, this is a key change that we've got to track. This has been the epicenter of this equity market for a long, long time, and the bulls like this stock for a number of reasons. Asset light, capital return heavy, and we're starting to see a pivot now. We're seeing it with Meta, and we start to see some pushback in the equity market. Now, we've spoken to people in the credit market so far this morning. Credit market is wide open for this issuance, welcoming it. We saw the Meta issuance in the last week. Order book was absolutely monstrous. Any signs of pushback in equities? Maybe it's starting in debt. Not at all.
Because people are taking a look. Just as we were talking to Amanda Lynam, she said their cash flow is still tremendous. It's not as though these are incredibly hyper-leveraged companies by any means. And frankly, they see the potential for not having enough supply of the cloud as an existential risk. So for them, it is important to get out there and to actually build capacity. The bigger question to me is how much is the entire market leveraged to the idea this is the AI model? There isn't going to be some technology that intercedes and creates a greater degree of efficiency that renders some of the cloud computing, some of the data centers, some of the other infrastructure less relevant.
And this is what Microsoft was talking about. They feel like they're trying to keep up, but they actually feel like they are really struggling. So they need to go out and do more. You look at what's going on in AI, and then you think, how is the Federal Reserve too restrictive? And this was the argument Governor Miran was making earlier on this program.
Includes some 50-year debt, just seeing that headline right now in case you're interested in any of that, Brahma.
Well, yeah, the idea that you can lend to a company like Alphabet that was challenged just 3 years ago from the likes of OpenAI and ChatGPT, 50 years out, what are our Google searches going to look like? It's just going to be a chip in our brain. We'll just sort of search our brain and figure out what comes up.
I've heard people draw comparisons to the railroad, but the tracks stay, and you keep on using them for a long, long time. We're talking about certain assets here that depreciate rapidly, very quickly. This is a different beast. It's a completely different beast.
We also have no visibility of how much AI is going to transform the way that we work and the way that we understand information, frankly, how we communicate. So there are a lot of questions here. 50-year debt is pretty ambitious.
Going to be talking about the credit market through the next hour. Coming up, we'll also catch up with Mike Wilson of Morgan Stanley as stocks trade very close to all-time highs. Jed Dorsheimer of William Blair as Tesla shareholders prepare to vote on Elon Musk's $1 trillion pay package. Bob Michael of JPMorgan Asset Management drops by the studio as well as traders look for more clarity on the path ahead for rate cuts. We begin this hour with stocks edging higher to kick off a new month of trading. Mike Wilson of Morgan Stanley writing the following. We expect the uptrend in earnings revisions breadth to resume into year-end 26. Third quarter earnings season provides a strong stock picking environment. Mike joins us now for more. Mike, good morning, sir.
Good morning, John.
I want to pick up on, I think, a core view of yours for 2025. Going into 2026, recession's behind us. I think that's somewhat unique to you and the team at Morgan Stanley. Just build that out for us.
Yeah, I mean, we try to work 6 months in the future. I think, a year ago, remember we had this conversation after the election. You were saying, Mike, you sound more optimistic than I've heard you in a while. And it was we were thinking 6 months in advance. We thought the first half would be tough as they transition from the kind of growth negative policies to these growth positive policies. All this CapEx you're talking about is right in line with the big beautiful bill. I mean, they're trying to basically reduce consumption, increase investment. Okay, it's a totally different economy, and what that is, it's a higher velocity economy for all the companies that haven't been doing well for the last, I would say, 3 years. We've been sort of in a recession. I would argue strongly, we've done the work on this, and we've done the analysis with respect to the rolling recession that has been in place for, I would say, 3 years. Most of the private economy kind of suffering, government kind of carrying the water. And then we basically saw all of that come to fruition at the end in April. April, capitulation day, as I call it, was basically the government recession. That was the final piece of the rolling recession. And if you actually look at the challenger job cuts and you look at the revision data now on the payroll data, it looks to me like a rate of change low, okay, in payrolls and a rate of change high in challenger job cuts came in April. So the market's figured all this out. That's why revision breadth has gone straight up.
So rolling recovery, where are we in those stages?
Right. So we deemed it the rolling recovery in April, and we're now seeing that like these areas of the market are not everything's going to recover at once because it's an unorthodox recession. It's not like everything flushed at once and everything recovers at once. So it is going to be staged, and we've seen that in the market. We're still narrow. Quite frankly, AI, CapEx is kind of the one early recoveries here. Semiconductors being an early cycle group, but we're not seeing the other quote unquote early cycle groups recover the way they typically do in a new economic cycle. Why? Because the Fed is behind the curve. The Fed is way behind the curve on rates. They need rates much lower. If you really want to get the private economy moving, rates are too high.
Much lower. How much lower do you think that really is required to get that broadening out?
Well, let's just start with the 2-year Treasury yield. Okay, so my barometer is always the Fed is behind the curve if Fed funds is above 2-year Treasury yields. And in order to stimulate the private economy, I would say they need to be well below that. So that's 50 basis points just to get to neutral, and maybe another 100 plus to get to something that's more stimulative for the average company and the average consumer.
Are you right now betting on that broadening out and expecting maybe AI to underperform going forward as they invest more in some of these debt sales and the infrastructure side and the rest of the economy plays catch up? Absolutely.
Think about the trickle down effect of this capital spending. I mean, it's not just going to be semiconductor companies. There's a lot of infrastructure, there's a lot of job creation, there's a lot of velocity in the real economy. And the lending channel starts getting going, perhaps for small, medium businesses, that job creation. Deregulation is another part of that story. Okay, so absolutely that's what should happen if things play out the way they could. Now, there's risk to that. Let's say the Fed continues to say, hey, we still think there's inflation risk. We don't like the inflation rate at 3%. We're not going to raise our targets there. And then we just kind of drag their feet. It's going to stay narrow then. It's going to stay up the quality curve. And that's where we are right now, Lisa, is that people basically are trying to choose between those two outcomes. And I would say right now, most of the institutional community is still huddled into the high quality stocks. They haven't really made the transition yet.
Have you?
Well, we have in some of our guidance, yeah, absolutely.
In order for that transition to work, the Fed has to cut, though.
That's right.
That's what it's contingent on.
It's one of the main things. Now, dereg is a big part of that, okay? The capital spending is a part of that. Those can happen without the Fed cutting significantly, but it would really solidify it for me. And if you go back and look at all these different economic cycles, small caps and lower quality stocks typically don't outperform until the Fed gets below 2-year Treasury yields. We've documented this. So, by the way, it doesn't mean these stocks can't work in absolute terms. It just means that relative outperformance you typically get in that early cycle rotation needs Fed funds to be much lower.
If you look at the Fed next year, are you just expecting a Federal Reserve that's markedly different than it is today?
Well, I think they're being patient here. They're doing their job. I'm not one that sit here and criticize the Fed left and right. What I see is just a very weird economic cycle. And I think we've solved the puzzle a little bit on this, and that's why I feel fairly confident that our narrative we laid out this year is played out now. I'm getting evidence in the marketplace, and I feel more confident in that narrative. And that's sort of the difference. I just think they're not there yet. They're not where I am in my head. I could be wrong, but I'm pretty confident about that outcome.
Can we finish on big tech?
Sure.
These companies are changing. We're used to companies that weren't investing tons. Ultimately, they were giving it back to shareholders. Now we've seen a subtle twist, I think, from the likes of, say, Meta, who are spending tons and tons and tons, and then coming to the debt market to fund it. That's not what we're used to with these names. Typically, they're asset-light, capital return heavy. Are you noticing the same change? And how should we treat those companies differently, if at all, because of that?
So let's talk about the risks for the bull market. We think a bull market started in April, new economic earnings cycle. Okay, there are two risks. One is that the Fed drags their feet, liquidity, funding market stresses kind of pop up. The second one is what you just talked about, is that the market starts to push back on the fact that free cash flow growth is actually decelerating for some of these businesses, and the asset-light story is being called into question. We haven't seen it yet, although last week was the first time we saw pretty divergent performance between some of these, and that's a risk, because if all of a sudden the market starts to become a governing factor on those stocks, I can guarantee you that the management teams are going to say, well, maybe we aren't going to spend quite as much, just like we saw in the fall of 2024, as we talked about that deceleration in CapEx. Yep. And also we saw that with other times when these companies spend much money. The market is a governing factor. The management changed their view, how they're guiding on the CapEx. Right now they're getting rewarded for more CapEx.
The market, is it welcome news that they're leaning on the debt market a little bit more, just as this equity market starts to push back?
Well, I think it's a natural evolution. And just to be clear, in all of these build-outs, whether it's railroads, electricity, the internet itself, okay, we're now into the debt part. Okay, so now they just raised a ton of capital. Well, they're not going to sit, they're going to spend it. So that's another reason to be excited on one hand, because we know that money's going to get spent. It's not going to sit there and collect dust. So typically it could last a year, 2, 3, I don't know. But it's hard for me to believe that the spending cycle's over when they just raised gobs and gobs of dollars.
Do you think it jeopardizes capital return programs as these companies take on more leverage?
Yeah, it's competing for the free cash flow. So whether it's CapEx, and by the way, CapEx now as a percentage of free cash flow is pretty high for these businesses. But once again, I want to go back. This is by design. Okay, the tax bill is basically incenting these companies to do it now. The government, the administration is really encouraging businesses of all types to start investing for the first time in 15 years. We've underinvested in so many things, not just AI, but infrastructure and factories and automating production and robotics and things like that. This bill is designed to get that engine of growth moving.
And it's happening. Just putting all these pieces together, this was a core theme, I think a core pillar for being long US equities for a long, long time. And now it's changed. Is it still good? I think that's what I'm trying to get at here. Is this still an argument to buy US equities?
I think that the valuation, is telling you that the growth is going to be better than we think. My view is that earnings growth is going to be better next year than people expect. Now, on the other side of that, I do think we're in a different environment where we have these hotter but shorter cycles. Okay, so we're not in these 10-year economic expansions anymore. And it's 2 years on, 1 year off, 2 years on, 1 year off. That's what we've had since COVID, right? 2020, 2021, good, 22 bad, 23, 24 good, 24, 25 not so good. Now we're into a new 2-year cycle. So you just have to understand that because inflation is right under the surface and now you have a higher velocity economy, that means you're going to have to trade it a little bit more. But right now, I think it's we're in pretty good position.
Mike, it's good to see you. As always, thanks for being here. Mike Wilson of Morgan Stanley, piecing together the puzzle of the S&P 500. Something really reflexive about this. Bond markets rewarded Meta for it. Even with the pushback of the equity market, the order book was absolutely monstrous. So what do you do if you're one of these companies? You're being rewarded to do this, to basically come down in your credit rating, take on additional leverage, issue debt because the bond market wants it, and the equity market will reward you for the growth you might get further down the road. Why wouldn't you do more? Which is basically adds to the argument that ultimately you end up with a big misallocation of resources and tons of spare capacity down the line.
But pretty much everyone's saying that we're not there yet. So keep on going and dance while the music is going. And that's what credit investors are saying. I think that the interesting point here is that might mean that in terms of leadership, they can't gain in terms of the big AI players because they are in an investment cycle that doesn't have the capital return financing, the capital return structure that you're talking about. So it allows some of that money to get invested in the economy. And then that sort of goes to the broadening out that we heard from both Mike and Brian Belski.
It's a change in market. Futures are higher by 0.2% on the S&P 500. That's the price action. Let's get you an update on stories worldwide this morning. Here's your Bloomberg brief. The President, Donald Trump, declaring NVIDIA's advanced Blackwell AI chip, which he calls 10 years ahead of the competition, will not be available to other countries as concerns grow about the potential sale of a scaled-down version to China. Elsewhere, Alphabet looking to issue even more debt, proposing an 8-part dollar bond sale. This comes after marketing 6 euro-denominated benchmark tranches. Alphabet is raising funds to support record capital spending on artificial intelligence and cloud infrastructure. And finally, the Dodgers have won the World Series, defeating the Blue Jays 5-4 in Game 7. Miguel Rojas and Will Smith delivering the key tying and go-ahead home runs as LA became the first repeat champion since, guess who? The Yankees back in 2000.
I know. It's a little bit sad that the Yankees were not part of this, but I have to say, to all those Toronto fans that have been messaging me that I should stick to politics and not baseball, I told you it was going to be showtime.
Is that you getting back at them?
Yeah, I think I have a right for a little bit of smack talk, given the fact that they have bombarded not just the Bloomberg terminal, Instagram, Twitter, LinkedIn, We hear you, Canadian fans. They're very polite, but they're telling me to stay in my lane. Now, look what happened.
You're probably lucky the Dodgers fans are still asleep because they'd probably have things to throw your way too. Up next on the programme, we'll get you some morning calls, plus Jed Dorsheimer of William Blair as Tesla shareholders prepare to vote on Elon Musk's $1 trillion pay package. That conversation up next.
We are going to see a broadening out of the market. I think we're heading into Goldilocks. I think we're heading into where you have to own a little bit of everything, not just tech, not at the forsake of selling tech, but continue to be a fundamental bottoms-up investor. Let the market do what the market does.
Brian Belski at a new firm, Humilis Investment Strategies. Congratulations to Brian. Congratulations also to Tom Porcelli, formerly of PGIM, hired by Wells Fargo. That headline just crossing. The PGIM economist Tom Porcelli joining Wells Fargo as chief economist. Just getting that headline moments ago.
Yeah, and I know that he will enjoy having some yoga on his time off, and then he'll come back with a newly inspired view of the world. So we look forward to that.
Very chill, isn't he, Tom Porcelli?
Spent the gardening leave, I believe, doing yoga, and he came back so centered and rested. I was thinking, wow, I need to get me some of that.
Very cool. Futures on the S&P this morning. Good morning to you all. Positive by 0.2%. On the Nasdaq, up by 0.6%. On the Russell, just about unchanged. In the bond market, bond yields shaping up as follows. 2-year bond yields higher by 2 basis points. 10s up by 3. 30s up by 4. Bit of crowding out this morning, maybe. A lot of debt coming to market.
Yeah, the idea, I have to go back to this. The idea that Alphabet is selling a 50-year tranche of this 5-part sale that they're bringing to market just raises this question. How tolerant are investors to the idea of the likes of Google being there for the next half century in the form that they are now, given how quickly the technology is developing? I mean, it's sort of mind-boggling, but at the same time, income is income, so I guess people are excited by that.
Yields are up across the curve on the Treasury curve. We'll see how that Alphabet issue goes a little bit later this morning. Let's get you some morning calls. First up, Wells Fargo raising its price target on JPMorgan to $350, calling it the, quote, best-in-class global bank. Your second call from Bernstein raising its price target on Apple to $325, citing its better-than-expected iPhone 17 launch. And finally, Loop raising its price target on Nvidia to a street-high $350, saying its latest GPU ramp will double its shipments in the next 12 to 15 months. Let's stick with the Max 7. Tesla shareholders gearing up to vote on CEO Elon Musk's $1 trillion pay package on Thursday, with the board split on the compensation. Bloomberg's Craig Trudell joins us now for more. Craig, what are the arguments on either side?
Yeah, I think with Tesla's board, they've put this together to essentially make up for the fact that the 2018 award that they arranged for Musk that was thrown out by a Delaware court, they want to sort of make good on the fact that that was sullied by the judge and, set some sort of similar, stretch goals for the company that he was able to achieve after that 2018 package was put together for him. So that it's a sort of win-win for shareholders. I think the counter to that we've heard from, for example, from proxy advisors, ISS and Glass Lewis, is that this is just sort of unfathomable amount of compensation for one person, and that some of the same flaws in sort of how this was put together, are similar to what was faulted, with the 2018 package, and it just may be the case that you don't run into the legal issues that you did with the 2018 deal because this company is now incorporated in Texas, and we don't have the Delaware judge able to insert herself again here.
That's an important development. Craig, appreciate the update. Thank you, sir. Craig Trudell there over in the City of London. Let's stick with Tesla. Jed Dorsheimer of William Blair has a market perform rating on shares of the EV maker. He writes the following: we expect this to pass in the same manner the 2018 plan did, as well as the ratification of that plan last year. Jed joins us now for more. Jed, welcome to the programme. I think it's important to take a step back and go back to 2018. I remember when the news crossed and it felt like it was totally unachievable. Then it was achieved and then people complained. Jed, does it feel the same time this time around?
Yeah, I think what the one difference here is I think this is going to be a litmus test on corporate governance. I mean, here we've really never had this before to this extent where, you have shareholders that have voted for in, 2 times. And when we look at the the amount of value that's being created, and then you have two organizations that really have no skin in the game that have the ability to try and block this. So if it doesn't go through, I think that's going to be very negative for the shares, and ultimately the brunt is going to be on shareholders.
Jed, why is it going to be so negative? Because you think that Elon Musk is going to be at risk of leaving, or because he is going to be at risk of not necessarily getting to those types of achievements that are put out there in the bonus plan?
Yeah, I think he's at risk of leaving should this not go through. He has made it very clear that he is not going to be CEO of a company that's developing a army of robots, for example, and robo taxis. And so his take is that the technology is powerful enough, and if he doesn't have oversight of that or control of that, then he is not interested. And so I don't know whether or not that means he leaves, or whether or not, but he certainly has options. And I think that, I think it would be a mistake to not look at Elon as the magnet that attracts the talent at Tesla. So I think there's a lot of risk should it not go through.
On a broader level, Jed, I wonder what it says about a company if there is such key man risk, given that key man seems like he is potentially willing to leave if he isn't given $1 trillion. I just wonder if that exposes a fault line in Tesla that makes you reluctant to be as optimistic as you otherwise would.
Well, I think it's a mistake you're focused on the amount of pay. And I think this is where there's a broader misunderstanding. The trillion is only achieved if you get a 7x increase of overall value for the company. And so, I think there were similar parallels to Apple with respect to Steve Jobs. And we have to look at what is the value that's being created here versus a large number of executives that get paid when they destroy value. And I think there's a meaningful difference there. And in fact, I'd like to see more pay packages that align, compensation with investor outcomes, which I think if they, we'd be hard pressed to argue that if Tesla grows the market cap by 7 times, that shareholders aren't benefiting more than that of Elon, even though the absolute dollars that he would get in through the package, are enormous. And I think that enormous part is what people have difficulty with.
It sounds like he's making the case, and you're on board with him, that he doesn't want to be sidelined. But can he not be sidelined and have something that maybe for some investors is more appropriate than $1 trillion?
Well, what is the problem, though, with the trillion? I mean, I guess that's what I kind of push back. Like, I get it's a huge number that's unprecedented. But at the same time, you have to look at, we haven't seen value creation, to that level. And there's risk. I would have a bigger problem if he's getting that money regardless of the outcome, or if there were clauses like that, which there aren't. So that would be my issue. And again, look, we're neutral on the name right now. It's not as if, there's a dog in a fight with respect to that. But I think that there is a lot of shareholder downside. If you just do the math on this, I think as a shareholder, I would be very concerned, particularly if an organization that didn't own any shares was making that vote.
Jed, super well framed. Appreciate your time. Jed Dorsheimer there of William Blair. Don't get distracted by the big flashy number. Focus on the incentives. If they're making money, he makes money. And if they don't, he shouldn't. And that should apply to most companies in corporate America, but unfortunately, it doesn't. From New York, this is Bloomberg. Three-week winning stretch on the S&P 500 this morning, up again by 0.2%, 6-month winning run on the benchmark in America, looking to make it month 7. Month 7 already there on the NASDAQ 100, 7 consecutive months of gains for big tech. That's the longest streak going back to 2017. This morning higher by 0.5%. The opening bell about 60 minutes away. Let's get you some single names, some morning movers. Here's Danny with more. Hey, Danny.
Hey, John. Leading the gains for the Mag 7 this morning is Nvidia. Shares are up just under 2%. A couple things going on. For one, all of tech is rallying. Also, Microsoft finally allowed to ship the latest and greatest Nvidia chips to the UAE, helping Microsoft's investment in the region. That comes off the back of a deal that President Trump made with leaders in the UAE back in May. Elsewhere, a lot of deal news to sort through. One of them, the big one this morning, being Kimberly-Clark buying Kenvue in a deal that values the consumer goods company at $40 billion. Kenvue has been struggling since it was spun off from J&J. It's had a lot of activist investors circling around. It also makes Tylenol, which has had some political drama behind it. Kimberly-Clark shares, for their part, down 14%. Finally, wrapping things up with Beyond Meat this morning, a wild ride this company's gone on. It's been a meme stock, so it's been up, it's been down this morning, falling by 8%. It was supposed to report earnings tomorrow. Instead, it says it will delay that earnings report till November 11th. It said it's taken a large impairment charge on some of its bigger assets. It didn't detail exactly what that is, but it said it will be a significant charge, and it needs more time to figure out exactly what those numbers look like. So Beyond Meat down 7.5%, John.
Yeah, that's never good. Danny, thank you. Looking forward to the program. Bloomberg Open Interest coming up with Danny Berger and Matt Miller about 30 minutes away. Let's turn to the economy. Traders relying on alternative and private data this week with the shutdown nearing historic length. Bloomberg's Mike McKee joins us now for more. Mike, we won't get payrolls, but we get a lot of other data points.
We do get some data points that people are going to be paying attention to starting today with the ISM manufacturing numbers. We'll look at the headline, but of course everybody's going to want to look at what the payroll numbers tell us and what the price action is. On Wednesday is the big number of the week. Can you believe, Lisa, we're saying this? ADP. ADP is going to be the only major comprehensive number for the month in terms of employment, so it'll get an awful lot of attention. ISM Services that day also will have an employment component and a prices component. Thursday, estimated claims, we'll have these late in the afternoon when they release the raw state data. They're not going to be exactly accurate, but what we've seen in recent weeks is we are getting a lot of layoffs in the numbers. Friday, Michigan sentiment. We'll see how people feel about inflation expectations. It's more about these alternative data sources, as John said, than it is about what's going to happen, what's not going to happen from the government. A lot of data not coming out this week. Jobs on Friday is, of course, the big one we're going to miss, but we don't get trade and jolts on Tuesday. We don't get productivity and the real claims numbers on Thursday. All of this stuff got to come out at some point once they get the government open. We don't have any idea when that's going to be. But filling the gap, we do have Fed speak this week. Coming up later today, Mary Daly and Lisa Cook, her first comments since the Trump administration went after her, trying to fire her. We'll see what she has to say, if she talks politics or just the economy. And as you can see, a very busy week the rest of the week, particularly on Thursday with 6 different speakers. And Friday, Phil Jefferson, the vice chair, speaks for the first time in a long time. He doesn't speak very often. And Stephen Miran, who was just on with you, will be talking about stable coins, something different for a change from him. We'll see what he has to say about that.
Mike McKee, thank you, sir. Appreciate the update. Michael McKee looking ahead to a week full of data. Don't get the usual suspects. No payrolls data this week, but you will get the ISM's, ADP and job openings. Let's stick with the alternative data. Nancy Lazar of Piper Sandler writing, look past the scary AI job-destroying headlines. Keep an eye on claims, NFIB jobs, S&P PMI employment, all showing incremental improvements in the labour market. Nancy joins us now for more. Nancy, good morning.
Good morning.
Is the worst of it behind us then?
I think so. I think we are at a positive inflection point in the economy. No question here in 4Q with the government shutdown, you're going to have a little bump in the road. But it's important to look at the trend. And you're getting plenty of green shoots from all those indicators that you mentioned, even on the job side. Although Amazon is laying off people, claims are incrementally low. Amazon probably overhired during the COVID crisis. They're just renormalizing. And importantly, the big guys don't create jobs. It really is 80% of jobs are created in companies with less than 500 employees. And so that's why the increase in the NFIB index is so important. There's also the S&P PMI that comes out today. We already have a preliminary October reading for that. That employment component is positive. Conference boards, jobs data were a little bit more positive. Regional Fed employment data, and it's important, we're also positive. And it's important, it's manufacturing. Manufacturing has a much bigger multiplier than the service sector. And so I'm actually excited that it's starting with the manufacturing space.
Can I pick up on claims?
Yeah.
How instructive are jobless claims when they've been pretty stable through the year, as payrolls have decelerated quite aggressively since the start of 25?
So first on payrolls, it's a misleading indicator. It should be reported mainly, maybe once a quarter until they have a better sample size. They're trying to capture over 20 million companies in 250 industry groups. It was just revised down 900,000 after being revised down pretty consistently in each of the past 4 years on a monthly basis. So lousy data. I would much rather look at the survey data that we've been focusing on. And claims. Claims obviously capture firings. What continuing claims show you are hirings. And so we've had limited firings, which is what claims show you, but companies are reluctant to hire as of now, given that they're trying to protect their profits, a lot of economic uncertainty. But we would look for, as we go into 2026, for continuing claims. That's going to be the key metric to watch as far as our companies getting ready to start to hire. As of now, no. But with lagged effect of the Fed easing cycle, the Fed's eased over 100 basis points, 150 basis points over the past year. We would argue they already are plenty accommodative, and that's improving corporate profits, and that will get you rehiring as we move into 26.
I want to pick up on something that you noted, which is that there's a transformation underway in the economy where it's going from some of these white-collar jobs where you are seeing layoffs, and you're expecting to see hiring pick up in the manufacturing sector. Is this a big transformation that you can really put your finger on and say, this is what's going to happen, this is the future? Maybe go to tech school, I'm thinking of my kids, and get yourself, some kind of degree in more of the manufacturing sector than anything else.
1,000%. Palantir was in the news last week. They're hiring high school kids. Great idea. Get a job, then see if you want to go to college, or if you need to go to college. Yes, I think this is transformational. It's actually been unfolding for about 15 years. It started last cycle when capital spending started to come back to the United States. China just wasn't a great place to do business anymore like it had been. And so we started to get onshoring. We started to get goods producing jobs increase 2010 through 2019. That's important because it's a huge job multiplier. When you create factories, you need a support system around it. Other smaller factories, distribution centers, and then other services eventually unfold. So I do think this is transformational. It's healthy for the economy. Not everybody needs to go to college, wants to go to college, and there should be other job opportunities. And yes, I think it is transformational.
This is one fear that people have, that there's a huge skills gap right now, whether it's AI and some of the technology that's coming to the fore that's making companies more efficient, or whether it's some of these more technical fields where people just don't have the training or expertise. Is there something that's going to be friction in this transformation that you see as a problem that's needing more easing from the Fed, that's needing a little bit extra oomph to give it that support?
No, I would say no more oomph from the Fed. All they do is create bubbles versus creating a healthy economic backdrop for middle America. Those big easing cycles create a great environment. I think one of your guests said that this morning for Wall Street. Let's focus on Main Street, where you can have maybe slow inflation, relatively low interest rates, and a solid job cycle. Train them. I visited a prison about 6 years ago where they were training inmates as they got parole in skills. And they would train them and they'd go out, they'd get on parole and they would get a job. So you can train people to work in factories. I grew up in a factory town. I saw it myself, and it's train them. That's not a big deal. Penny Pritzker was really focused on that early last decade. Community college system, companies working with community colleges. No, I'm excited about it, rather than people depending upon the government where they can actually go out and get a healthy, good job.
Do you think there's been fresh impetus on this because of the Trump administration trying to get manufacturing back into the United States by using a carrot and stick approach with tariffs?
Yeah, certainly that's reinforcing it. But I really want to emphasize the private sector first started to do it. Back in 2010, I listened to companies, and companies were complaining about the difficulties in doing business, stealing technology, AI, heavy hand from the government. And so this has been going on for 10 years. And to be sure, I like your description, the carrot and the sticks, absolutely. And the thing on the carrot, it takes time. Same with a stick. It takes time to build these factories. And so we've seen a lot of announcements, about 45 announcements this year of major companies announcing construction of new facilities, but to plan those facilities, then to execute it. And that's what I like about it. It's slow, it's not fast, and it can create a sustained cycle, potentially even another one of those long business cycles that we saw in 2010 through 2019.
If we do get some layoffs, the Financial Times had a story about this, how companies are just going to say it's AI. Do you think it really is down to AI, or that is just politically easier and more beneficial them to blame something that they're going to have to deal with in a few years, or maybe not they're dealing with right now?
It's probably a little bit of both. First, every business cycle upturn is led by technology. If you go back to 91, 2001, 2000 tech, if you look at GDP, tech capital spending has always led because it gives you productivity, profitability, and then you can get jobs. Classically, these upturns, you do have a slow job market because, yes, companies are trying to protect their profit margins. So maybe it's a little bit of excuse, but the CapEx we're seeing being spent on AI is leading the economy, and it will give you old economy CapEx as you go through the year. So maybe it's an excuse, but at the end of the day, it's not unusual to have a sluggish upturn in employment going into a reacceleration.
Nancy, it's good to see you.
You too.
Always great to catch up. Nancy Lazar there of Piper Sandler, slightly more constructive on the outlook here. Just getting this headline, confirmation, Alphabet looking to raise $15 billion from a dollar bond sale, 15 after Meta's monster issue last week.
Yeah, and honestly, this is sort of the beginning of a tsunami of debt that is going to go to investment. I just wonder at what point does it become an issue for the stock traders versus the bond investors that seem to be welcoming it. The 50-year tranche. Very curious how that does.
Arms wide open now, apparently, based on the order book of Meta.
Yeah, it was a very big order book for Meta. 50-year debt? I don't know. Remember when Argentina came out with theirs?
Are you drawing a parallel between Alphabet debt and Argentina?
I'm not. I'm just saying that a lot of things can happen over a long time. No, that was probably not, but they both start with A.
No, you know what? At least the country's going to be there in 50 years.
Exactly, but that's
the difference when it comes to corporations.
I know.
Alphabet up by 0.6%. Coming up on the programme, we'll be catching up with Michael of JPMorgan Asset Management to get his views on fixed income. Before we get there, let's get you an update on stories worldwide with your Bloomberg Brief. The US pausing some of President Trump's reciprocal tariffs on China and halting plans to implement a 100% tariff on Chinese exports to the US. In return, China immediately suspending export controls on rare earth metals and dropping its probes into US chip firms. Elsewhere, Microsoft signing an approximately $9.7 billion deal to purchase AI cloud capacity from Miran, becoming the Australian company's largest customer. The 5-year agreement will provide Microsoft access to NVIDIA accelerator systems in Texas. And finally, staffing issues triggering multiple ground stops at Newark Airport in New Jersey this weekend. The stops causing delays and forcing the cancellation of more than 100 flights. Air traffic controllers working without pay during the government shutdown. And that's your Bloomberg Brief. Up next, as promised, we'll set you up for the day ahead. Plus, Bob Michael of JPMorgan Asset Management with big tech taking on new debt to fund AI. From New York City, you're watching Bloomberg TV.
What matters for the stance of policy is where you are relative to the neutral rate. And if neutral is here and policy's up here, you're very tight. If neutral's here and policy's down here, you're very loose. But if you stay where you are and then neutral goes down, you've passively tightened because the neutral rate has shifted. And so policy has grown tighter over the course of the year. I think that we're a fair way from neutral, and I think that we could get there a bit faster. I could imagine getting there in a series of 50 clips.
Governor Miran of the Federal Reserve, his first broadcast interview since that dissent last week to push for a 50 basis point reduction. And it sounds like he's going for 50 again when they get round the table in December for the final meeting of 2025. As we count you down to the opening bell, here's the trading diary for the week ahead. 9:45 a.m. Eastern Time, some data. S&P Global Manufacturing PMIs at 10 a.m. Eastern Time. ISM manufacturing data. Tuesday, election day in the US and earnings from AMD. On Wednesday, ADP employment data. ISM services, earnings from Qualcomm, plus a Supreme Court hearing on President Trump's tariffs, and on to Thursday, a Bank of England interest rate decision. Let's turn to the debt market. Big tech looking for more cash to fund AI spending. Alphabet expecting to raise $15 billion in an 8-part dollar bond sale. The move coming just after Meta issued $30 billion of debt just last week. A man who might be buying some of that, Bob Michele of JPMorgan Asset Management, joins us now for more. Bob, good morning.
Happy to be here.
Hey, it's good to see you, sir. We talked about the market being arms wide open for this tech debt, is it? Do you see the same thing?
Yeah, I think so. And I think the tech companies are pretty smart to issue in a relatively flat yield curve. They do have funding needs. They've got expenditures. And why not tackle the market right now? There are a lot of pension funds and insurance companies out there that are looking for high-quality debt in the longer end of the yield curve.
Well, let's talk about the longer end. Lisa talked about it. We all did. 50-year debt for a tech company. Can you help sort of a normal person understand why a credit investor would want to buy 50-year debt of an American corporation, particularly in the tech sector where things change minute to minute, never mind decade to decade?
Well, we'll see how that goes. I'm all for a 50-year U.S. Treasury, but if you think about corporate America and look in 50-year installments, they do change quite a bit. I'm not so certain about that one.
Okay, so you might not be buying the 50-year bond, but at the same time, the other longer duration tech sales you're okay with. I'm just wondering if what we're seeing is a tip of the iceberg. If there are a lot of issuances, maybe not of the Metas and the Alphabets and the Microsofts of the world, but the less credible ones that are also getting a pretty good reception in the bond market, does that worry you?
Not right now. It worries me if I thought recession were credible over the next 12 to 18 months. And with the U.S. economy, that looks good, not fantastic, but good and solid, where we expect sort of trend growth next year. I'm okay with corporate America financing itself and seeing what it can do. There's also the One Big Beautiful Bill Act coming next year that has the $1 trillion in incremental spending attached to it. So that's a pretty nice tailwind for the U.S. consumer as well.
Governor Miran, when he was on the show earlier today, pointed to the private credit markets as harboring some of the risk that otherwise would be visible in public markets, saying that it isn't marked to market at any kind of current level. You're seeing a lot of tech investment there. Are you concerned that we're seeing the best of the bunch in the public markets, but there's a lot of other stuff that just isn't as visible that has seen some deterioration?
When I heard that comment that private credit is a symptom that credit conditions are too tight, I felt like I was having an out-of-body experience, because I think myself and the market broadly believe that what we've seen with a handful of issuers, that credit conditions are too loose. There's such an overabundance of liquidity out there that the marginal borrower with a questionable business model can access funding. Can it go on forever? I always say a rolling loan gathers no loss, and at some point, the weak business model, the weak borrower will be exposed. I think we've seen some of that. I think what we're actually seeing is credit conditions are quite loose, and perhaps it is in the private credit space. I don't think they're too tight.
What are you avoiding? As you speak, I'm listening to you talk about certain issues attracting a lot of capital, maybe when they shouldn't. What are you avoiding?
Well, that's a very high-level statement to address, but I think every sector of the market holds a lot of value. We do recognize we are in an extended cycle. It's being supported by a lot of macro policy. You have to be very issuer-specific. So we're relying on our credit analysts more than ever to keep us in the companies that we think will be the survivors over the next few years, and those that are going to have problems if there's a slowdown, if there's a recession. I'm not going to be tempted by a handful of extra basis points in yield.
What are the single name analysts saying about tech companies and how the character of these tech companies are changing? Typically very, very asset light. We talked about how heavy they were in capital returns for a long time. And when they came to the debt markets, it was for very, very different reasons. Maybe the profits were abroad, didn't want to bring them home, so they borrowed domestically to fund capital return programs. This is different. They're investing lots in assets, and some of those assets depreciate rapidly. How do you approach that situation as these companies and the character of them starts to develop, starts to change?
Yeah, the cable providers are a not too distant reminder of what can happen if you overinvest in capital. For me, Alphabet is a really interesting one. You go back to the dot-com bubble and the thousands of companies with .com in their name, they're one of a small handful that made it and made it in a big way. So they see something, they got it right then, they see something now they want to get right again, and that's a broader use for AI, probably for things we don't even know will exist 10 years from now. So I think businesses that are investing in AI, that are borrowing, that are trying to be the leading edge, yeah, they're going to make some mistakes. Not everything they do will pay off. Most of the things that they do will, but at least they're going to be part of determining what that looks like. You're right, it does change the way we look at these tech companies from just being cash generators and cash cows to something that are more balanced in borrowing.
Can I just jump in? As the credit investor, your guarantee, you hope, is that you get paid. You don't get the hopes and dreams and all the upside of the equity investor. And what I'm hearing and seeing now from Meta is that they're saying now, Lisa, you know what? I'm not going to lean on equity anymore. I'm going to go to the debt market and fund the hopes and dreams in credit. So you're on the hook. And I just see all the upside in the equity. Now, maybe I've got this all wrong. You can tell me if I have. But that's what it sounds like.
Okay. Let's not go crazy here. The amount of borrowing they're doing on their market cap and their free cash flow is a bit decorative. And I think what it's doing is it's just starting to set up the markets for we will be coming back regularly. We will be borrowing more to balance the way we finance ourselves. And this is what we're thinking about. I don't think it's so bad. I'm not that worried right now.
You did say that you think that financial conditions are too loose and that they're incredibly easy and that that's what concerns you, is that money is sloshing around in a way where things tend to happen. Where do you see that, and does a Fed rate cut make you more cautious?
What would make me more cautious is if the next Paul Volcker is going to be appointed to chair the Fed and comes in and says, stop the madness. Look at the 10 trillion in COVID policies out there. Look at the 8 trillion in QE out there. It's still in the system. How do we get it out? But we're not going to see that. Instead, we're going to go on with the experiment that we can borrow and spend. We can bring interest rates down. Maybe that will start the housing market. Recessions we can deal with very quickly on a weekend if they materialize. I don't want to fight that right now. I think it's good for the bond market. I think it's good for credit spreads. I think it's good for risk assets. Fed rate cutting cycles are not what bear markets and recessions are made of.
I used to think his name was Kevin Walsh. I'm not so sure anymore.
It maybe was, but Kevin Walsh has put on a different Halloween costume and seems a little bit different.
Left the building. Different guy. Bob Michael, good to see you. Thanks for dropping by. Thank you, sir. Bob Michael there of JPMorgan Asset Management. Coming up tomorrow, Torsten Slock of Apollo, Henrietta Trays of Veda Partners, Mira Pandit of JPMorgan Asset Management, and Kathy Boschantic of Nationwide. From New York City this morning, good morning to you all. Thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.
The WTA Finals in Riyadh. Aryna Sabalenka dominated Jasmine Paolini to clinch her first win of the tournament. The world number one fired 11 aces and 24 winners in the victory, which took just over an hour. Elsewhere, Jessica Pegula avenged her defeat to Coco Gauff in the recent final in Wuhan with a 3-set win. The defending champion hit 75 unforced errors in the loss.